market's pricing in just the right stuff coming out of D.C.
We've always viewed policy as either an accelerant or a dampener. By itself, it rarely makes trend.
The engine of the car, being the consumer, looks completely fine. Is it going to get turbocharged by some of these policies? I think that's probably a risk that we can't dismiss.
We're in this really sensitive period of time right now. The markets are really walking on pins and needles.
There are these exogenous shocks that are going to disrupt the cycle that we're currently in. We don't know the probability and we don't know the size of them, but we know that they are coming.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now, coming into Friday poised for the best week of gains since election week. That big, decent week of gains, and the first week of gains on the S&P of 2025 so far. We had some weight to it, up 1/3% on the S&P 500, on the Nasdaq up by 0.4, encouraged by earnings and the economic data, still nervous about what might change on Monday.
That's right. Monday is just going to be almost a whole new world. We're going back to the Trump era, and we got a little bit of what policies might be so important to the incoming administration. Yesterday, when we heard from Scott Bessent, who's going to likely sail through confirmation and become the next Treasury Secretary, he did say this. This is the single most important economic issue of the day. This is pass-fail. He was talking about extending TCJA. Wall Street Journal, though, reporting that on some other measures, Trump might leave Congress behind and go full throttle on himself. And what we're hearing or we're seeing in reports is almost 100 executive orders, Jonathan, in just the first few days.
And nothing to upset the bond market so far. For a third consecutive session, bond yields are lower. The 10-year yield this morning is down a basis point or two to 459.66. We haven't seen a 3-day winning streak on a 10-year maturity since early December. Governor Waller, super dovish.
Very
yesterday.
dovish, saying that we could possibly get a cut in the first half of the year if the data continues as is. Of course, reliability, that comes out, and then you get all the commentary, oh, is he just auditioning for the Fed chair? I don't see why both can't be true. Why can't he be dovish and doing that? I think we need to remember in 2023, Waller was the bellwether. He flipped to dovish. The rest of the central bank followed him. I think it's important to listen to Waller, not just write it off as him campaigning for the Fed chair.
He sounds like an outlier, though, and that's the issue, because of a lot of other Fed officials are concerned about policy changes in the year to come. We know the banks who think we get no rate cuts this year. Deutsche Bank, Bank of America, Mizuho, RBC, BNP Paribas expected no cuts in 25 based on what? An inflationary upsurge from the new administration's policies. And that's what we've all got to watch through the next few weeks.
And then you get someone like Kevin Warsh writing an op-ed who has also been tilted as potentially the next Fed chief, saying that the central bank is being too political, that they are using tariffs, and I guess you could wrap in that market participants too, as a scapegoat for possible inflation, saying that that's not what the central bank should be doing. They need to be smaller, and maybe that added to the bond market rally too, that's the kind of Fed chair we could get.
We're 3 days out from Trump being inaugurated, and where do we have a race for the Fed chair? But if you go back to how this incoming administration might use tariffs, which is something Kevin Warsh talked about in the Wall Street Journal op-ed, he was saying that Trump's economic policy is not just about tariffs. It's more than tariffs. Yesterday, Scott Bessent, when he talked about tariffs, he said, 1, it's to address unfair trade practices. 2, broad tariffs could be revenue raisers. And 3, they could be used as a negotiating tool. Basically, everything's on the table.
Lots to talk about this morning. If you are just joining us, welcome to the program. Equity futures up by 1/3%. Joining us through the next 60 minutes or so, we'll catch up with Christian Nolting of Deutsche Bank on a challenging start to the year. Isaac Boltansky of BTIG as Bessent clears his Senate confirmation hearing. And we'll catch up with the brilliant Erika Najarian of UBS following strong Q4 bank results. We begin this hour with stocks positive. Investors looking ahead to President-elect Donald Trump's inauguration on Monday. Christian Nolting of Deutsche Bank writing the following. Expectations for higher public deficits and uncertainties about announced tariff policies drove 10-year U.S. Treasury yields higher since the start of the year. Consequently, it has been a challenging start into 2025 for equities. Christian joins us now for more. Christian, welcome to the program, sir. Let's forget the data. Let's forget the earnings. Let's talk about day one of the Trump presidency. What are you expecting to change, sir?
Yeah, I think if you compare this to, say, 8 years ago, I think now the government is nearly already in place. So we have all the Congress hearings, of course, obviously. So it's an earlier start, I would say, than 8 years ago. And of course, there will be discussion about tariffs, how they implemented. Is it high or is it step by step? I think then a lot of, as you rightly said, right, executive orders to come in. I think to look through this a little bit, we, as I wrote, think that some of these policies at the beginning might be indeed inflationary. And I think that was one reason why we saw that increase in yields, which we actually predicted correctly, hopefully. And from that perspective, to come down a little bit in yields helps markets. So we have a very good week. But we shouldn't forget there are some policies, and by the way, not only in the US, there's a lot of fiscal policy, but also globally. No one is talking about austerity from my point of view, and hence we see that little bit higher yields and hence less Fed cuts, less cuts probably also of the other central banks.
Christian, what did you make of Scott Bessent's hearing? Is there anything in there where you're leaning in towards to understand potentially what Trump 2.0 could look like?
Yeah, from my point of view, what is important really how they start with the tariffs. Is it high and then going lower, as I said, or is it step by step? So that's not quite clear. I think that's quite interesting. Maybe we know more already this Monday. And I think then from our point of view, I think it's a continuation of policy. I think there was not so much surprise from the hearing yesterday to the markets, which I think is good news from my point of view.
Do you think the Fed will look at Trump's tariffs and think they're a one-off hit when it comes to inflation, or that potentially this could be more substantial?
Yeah, again, it's about the structure, but of course the Fed will look into that, right? So they have the growth goal, they still have the price stability, the inflation goal. Yeah, they will look at this. And of course, they need to take into account what's the inflation expectation, what's the inflation outlook. And I'm in the camp that tariffs are inflationary. Not everyone is. I am, at least at the beginning until things might adjust. And they need to figure that in. And I think it's not a surprise if it comes. So sure, they will look at this for sure, yeah.
Well, Christian, then maybe the market reaction has been very logical of higher yields, stronger dollar. But then one thing hasn't quite been logical. The idea with tariffs enforces that American exceptionalism. But today we're seeing the FTSE 100 at a record and the DAX at a record. What do you make of that?
Yeah, so being in Germany, maybe the mood on the economy might not be the best at this point in time. But if you look at the DAX index, 84% is not Germany, it's global, right? So if you look MDAX, SDAX, a smaller index, that performance is not as stellar as we do see here. So these companies are global and profit then a little bit from US exceptionalism as well. So in Germany is doing much more with the US than with China. That has completely changed. And from that point of view, also here in Europe, we have now seen that luxury goods had a boost, and that was not coming from China. Maybe it's more coming from the US side. So there's also a global phenomenon we should not rule out from that point of view, and we have to watch this. So that's not only positive for the US, it could also positive even more globally.
Well, can't we flip that on its head, Christian, and say in the S&P 500, 41% of the constituents get revenue from Europe? Shouldn't they then be under pressure?
Well, as long as you're global, I think you have growth, right? So it's really to the smaller companies in those economies who do not do very well, like here in Germany at this point in time. That could change, but I think that trigger, which is necessary then, also is to get some fiscal policy probably over here in Europe. So as you have had the elections already last November, so we are here in Germany going into election next month, and maybe that could be a trigger for some fiscal policy. And then I could say, as you rightly said, 41% is Europe. Maybe then you see more investors coming to Europe as well if they do see some fiscal policy. But I think they want to see that executed. And then the so far, they call, unlike Europe, could also come up with some better performance from my point of view. But it has to have a trigger, obviously.
Christian, I'm really pleased that Danny brought this up. Expectations coming into 2025 were really downbeat for European equities, very upbeat for US equities. The Euro Stoxx 50 is up 4 straight days, and it's up around 4% in that period. And some people are starting to ask the questions that Danny is asking. What needs to go right to keep this trend intact? You talked about fiscal stimulus. Now, we're sitting outside of Germany, wondering if the mood is changing around that story. You're inside Germany. Can you give us a flavour of the conversation? Are they actually open to doing more?
I think it's a political topic, right? So is Germany ready to do more? There's elections, obviously, in 37 days, not too far out. And the new government, the question is, are they ready to do more? I think they need quite a majority on this. So there's all this discussion about the debt brake. You need a 2/3 majority. And we need to see, is the German electorate ready to give a 2/3 majority to that government, or can they create that 2/3 majority? So I'm not talking about the seats, but the parties in the parliament. So can they be blocked by 1/3 of the very left or very right party? That's the question I think we need to watch. I think some fiscal policy could be doable. There's, I think, some money around, to be very honest. But I think before the election, that won't happen. And until then, people will wait and watch. Good news for Europe, as I said, Luxury goods did very well, which was a driver and a boost in the Euro Stoxx 50. And yes, you see indeed some outperformance year to date compared to the S&P 500. But if you look at productivity gains, if you look at the investment money, if you look at research development money in absolute and relative terms, is still pro-US. So I wouldn't change the call at this point in time. I really would like to see some change in Europe first before we change that call.
Granted, it is only January 17th, so I appreciate that, Christian. Appreciate your time as well. Christian Nolting there of Deutsche Bank. Thank you, sir. I'm on the same page, seeing the same story. Record highs on a FTSE, elsewhere on the DAX, 4-day winning streak on Euro Stoxx 50.
It's really impressive for a region where optimism had essentially vanished. And maybe this showed us just how low the bar is. It's not only the fiscal developments that are getting better, but maybe it's getting some help from macro, too. In the UK, finally having CPI come down. We talked about the accounts yesterday. ECB officials wanting 50 basis points of cuts. When things are so dire and you're so concerned, maybe you don't need that much to launch you to all-time highs.
Equity futures stateside doing better as well. We're up by a few tenths of 1% on the S&P. Let's get you an update on stories elsewhere. Here is your Bloomberg brief. Israel finalising an agreement with Hamas to pause the war in Gaza, suggesting a ceasefire is on track to begin on Sunday. The deal includes Hamas releasing 33 hostages, Israel withdrawing troops from populated areas, and freeing around 1,000 Palestinian prisoners. Elsewhere, Bloomberg News learning Treasury Secretary Janet Yellen's computer was breached by Chinese hackers, along with those of her 2 top lieutenants. Our sources say fewer than 50 of Yellen's files were accessed and nothing classified was taken. And finally, firefighters in Los Angeles getting a reprieve from the strongest winds today, but the National Weather Service saying dangerous conditions are expected again next week. At least 27 people have been killed and 60 square miles have been charred in the wildfires. And that is your Bloomberg brief. Up next on the program, an economic calamity.
If we do not fix these tax cuts, if we do not renew and extend, then we will be facing an economic calamity.
The latest on Capitol Hill up next on the program, live from New York City this morning. Good morning. Live from New York City, welcome to the program. Equity futures right now up 1/3 of 1% stateside. Check out Europe. Danny's all over it. The FTSE at a record high, up by 1 full percentage point. Yesterday, Richemont with some decent numbers, igniting a massive rally in the luxury players across the continent. And the Euro Stoxx 50 is up by something like 4+% for the year so far.
And I have to say, I talked about all the great things, not great things, but I mean, marginally better things happening in Europe for them. We also need to acknowledge that it's the U.S. also helping. It is CPI coming in a little bit softer, giving both central banks and fiscal policymakers more headroom. That's a good thing for their equity markets.
The data's better, the earnings have been decent, and I think we've stressed this repeatedly. Things can all change on Monday and the following week. Under surveillance this morning, an economic calamity.
This is pass-fail. That if we do not fix these tax cuts, if we do not renew and extend, then we will be facing an economic calamity. And as always, with financial instability, that falls on the middle and working class people.
Here's the latest this morning. Trump's Treasury pick, Scott Bessent, urging Congress to extend 2017 tax cuts, warning their expiration would mean an economic crisis. Bessent appearing on track for confirmation without specific objections from Democrats during yesterday's hearing. Joining us now, Isaac Boltansky of BTIG. Hey, Isaac, welcome to the programme, sir. We need to talk about executive orders and Trump Day 1. I just want to get your thoughts on yesterday. How do you think Scott Bessent did?
Look, I think it's clear that Scott Bessent is a mind at work, and I think that markets should be heartened by that, as I think all of us would like a steady hand in that role, someone with his experience in the Oval Office advising the president. But John, let's not kid ourselves, right? We are still going to be living and dying day to day by whatever Donald Trump is typing out on his his phone's keypad. So I think that it's heartening and positive, and Bessent's going to be easily confirmed, and he's going to be a stable voice in the Treasury Department and ultimately in the Oval Office advising the president. But the president himself is going to decide what tariffs are going to go into place and how those are going to be communicated to the market.
So we're expecting some 100 executive orders after Donald Trump is sworn in. Isaac, what do they look like?
I think it's going to be a busy day. I think that there's an enormous amount of anticipation around what we're going to see on Monday. I do want our clients in general to be aware that just because it doesn't come out Monday doesn't mean it's not going to happen. I think that there is a bit of a logjam there in terms of all the different things they want to do. From my seat, I think you're going to see a fair amount of paper focusing on immigration and border security. I think that that's one area where he's consistently said he wants to focus, and I think that there's some administrative levers that he can pull. My cautionary point there is I think that that's going to be one area that you see heavily litigated. So that's one area and one dynamic that we're aware of. I think you're also going to see a fair amount of orders on the energy front and the healthcare front. Those have less risk of litigation, generally speaking. So we'll be keeping our eye on that. And of course, there's a lot of signaling, Anne-Marie, right? We're going to have a lot of things that don't actually have teeth, a lot of things relating to the culture wars and things that I don't think that the markets are going to have to worry about all too much.
And the signaling's on the other side as well. Biden is continuing a ton of executive actions, even as staffers are starting to pack up their offices currently, right now. When it comes to tariffs, though, will we get executive orders next week?
I think that we're going to get a few. And look, my base case here is still that there's going to be an overarching incrementalism to the tariff policy from the Trump administration. I think that they are cognizant of the economic impact. And I think ultimately they still want tariffs to be used primarily as a negotiating chit. And the way that I think about this is for those negotiating chits to have any value, you still need to prove that you're willing to shoot the hostage, if you will. And so from a framing perspective, I think that ultimately they will move quickly on instituting new Chinese tariffs, likely using Section 232 or Section 301, which takes a few months to get there. And then maybe a few acute areas where they focus on issues that they have a fair amount of political backing for, things like going after European autos. But I don't expect the broad-based universal tariffs to be where we start from.
You make a good point that this is really year 5 of Trump, not year 1. But what is going to be different from 1.0 to 2.0?
Yeah, look, I think Anne-Marie, it's a lot of amplification, right? So we know there's going to be a deregulatory agenda. We know there's going to be a focus on tax cuts and border security, but there's an amplification of some of those issues. So on border security, it's not just focusing on the border, it's also the deportation dynamic that's in play. On the tariffs, I think that they have more of an awareness of the different tools, which is why you're hearing so much more about IEEPA, which allows the president to impose tariffs based on national emergency. That's something that they didn't really get their arms around until probably halfway through the first term. So in general, I would just say it's more awareness of the levers of power, and then also it's the personnel they have around them. You have very well vetted, truly loyal folks around the president, which should allow them to move a little bit more quickly, and I think ultimately avoid some of the potholes that they fell into during the first administration.
Well, Isaac, to your point, though, they need to show a willingness, in your words, to shoot the hostage, to do the most of extreme measures in order to use it as a negotiating chit. Do you think that that's well enough appreciated? Is this an administration that would be willing to go to the extremes?
You know, look, it depends. It depends which client I'm talking to, but I think that there's at least an awareness that the China tariffs are something that he is absolutely serious about. There's a fair amount of debate among the client community that I speak to as to whether there can be a grand bargain with China over time, but I think that we need to have that as our base case, that China is going to be where he moves quickly. Canada and Mexico, I truly think, are more about a conversation, more about one-off negotiations than anything else. And on the European side, I do think that he is a true believer, especially on the auto story. So I think what we have now is sort of trying to understand that bridge from rhetoric to reality and trying to get into Donald Trump's mind and the mind of those who are running this administration as to what they're really going to prioritize, because it's clear they can't do everything. So what is their prioritization hierarchy on tariffs?
Well, as Anne-Marie started this hour saying, Scott Bessent yesterday laid out several different use cases for tariffs. One of them that seemed to keep coming up was this idea of tariffs as national security, that sanctions pressure the dollar and its reserve status, and it makes more sense to use, therefore, instead tariffs. When it comes to China, Isaac, what is the strategy? Is it negotiation or is it one of national security, and that's why tariffs would be put on?
Yeah, look, I think that it's a full court press. That's how I think about it. And I think that there's more awareness here than there's ever been in terms of we need to have more of a holistic approach in terms of our competition with China. And you heard it yesterday during the hearing. I think it was noteworthy to hear how much was referenced in terms of our outbound investment screening. Look, we have screening for if foreign entities want to buy interests in the U.S., we should also have some awareness and some say as to outbound investment and what that means for acute areas of competition. And I think that it's one of the few areas of bipartisanship. And so we've got to be aware of how that's playing, not just politically, but also operationally in terms of the different levers of government they have, from CFIUS, which we've seen with the U.S. Steel deal, to acute areas of legislation like we've seen with the TikTok ban.
Isaac, the horse has bolted. The technology's already lost. I wish we were having this conversation 20 years ago, but we're not. And then I started to hear things like the TikTok CEO's coming to the inauguration. She's invited to the inauguration, not turning up, by the way. Isaac, what is going to be the approach to things like TikTok? If it is seriously a national security risk and Chinese hackers have infiltrated the Treasury and they don't care who's in charge, they could possibly do the same thing in the incoming administration as well. I don't really understand what the holdup is.
Well, look, I'm confused by Congress passing a bill saying that they want to ban TikTok, and now at this 11th hour, seeing many of those lawmakers from both sides of the aisle retracting their previous statement and saying we would love a reprieve. We would love to find a way to push this ban out. And so I think that there are always those political wins, which are tough to dissect. But by and large, when I try to step back and say, what does this actually mean for markets? What does this mean for investors? Is one of the persistent tailwinds that I see from a spending and a appropriations area is we're going to spend a whole lot more money on cybersecurity as a federal government. There's going to be a whole of government approach to cybersecurity that is, frankly, 20 years too late. But in terms of areas that clients ask, where are we going to plus up spending? Yeah. Where are we going to spend more and more, no matter who is in charge of that pen? It's cybersecurity and overall just defense and national security.
Forgive me for putting you on the spot, but what do you actually think happens with TikTok in the next week, Isaac? What's your base case?
Look, I think that we're going to get the Supreme Court order today. They have a release this morning. My base case has been that when you can bet on D.C. taking longer than it should, it will. I think that the Supreme Court is likely to say that they're going to continue deliberating on this. There's going to be a temporary injunction for a couple months while they do so, and that we get their order, I think, ultimately upholding the statute, which is negative for TikTok, but we're going to have to wait a couple months before that comes out.
Isaac, good to catch up with you, sir. Appreciate it. Busy week next week for sure. Thank you. Isaac Boltansky of BTIG. Some big changes through the next week or so.
Well, Ed Mills was saying how we can get the Supreme Court coming down, upholding the law passed by Congress, but then Trump comes in and gives an executive order and gives himself 90 more days to potentially find this off-ramp where they could be sold. So potentially we have a Supreme Court today making this decision. We'll wait and see. But they could uphold the ban. Shou Chew, the CEO of TikTok, shows up to inauguration Monday, sits on the dais, and then, of course, Tuesday, maybe there's 90 more days reprieve.
Before we get to Monday and Tuesday, do we know what happens on Sunday, on the 19th? Do we know what happens with the app?
Well, TikTok, according to the information, had threatened to shut itself down. Biden has made very clear, though, that that won't be the case. I don't know how you read this in any other way than TikTok called DC's bluff. They called their bluff. They said they'd shut down. TikTok isn't looking for a buyer. Yeah, we had that kind of trickle of information from China, but they basically said, we want to continue on as is.
And China is now using it as leverage and potentially hand-picking who they're willing to have this off-ramp given to.
Amazing. More on this story in just a moment. Coming up next, we'll also catch up with Erika Najarian of UBS on a record-breaking year for the big banks on Wall Street. That conversation is just around the corner. Equity futures on the S&P 500 positive here by 0.33%. We are almost there to the long weekend. It is Friday. Good morning. Equity futures on the S&P adding a little bit more weight to this week's rally. Higher by 0.4% on the S&P 500. On the Nasdaq 100 up by 0.5. In the bond market, something we haven't seen since early December. 3 consecutive days of falling yields. On a 10-year, we're down 2 basis points, 4.59. At the front end of the curve, anchored at 4.23. And in Europe, something we haven't seen since December 9th. 4 consecutive days of gains on European stocks. The Euro Stoxx 50 up by 0.75%. The euro a little bit firmer. I get it. It's January 17th. It's too early to get excited, but some outperformance on European equities so far this year.
Big outperformance. You have the FTSE and the DAX hitting a new all-time record just in the past day. These are two markets, if you would say, okay, what's going to happen to them if Donald Trump is going to be president? Your assumption would be that they would underperform. That's not what happened. They get a boost because sentiment was so bad, perhaps, but they also get a boost from better U.S. economic data, helps kind of ease the yield differentials, and really strong earnings from those multinational companies, luxury in particular.
Yeah, Richemont, fantastic in the past 24 hours or so, though we should stress once again, this can change with a tweet, a post, in the next week or so. Under surveillance this morning, Chinese President Xi Jinping is not attending US President-elect Donald Trump's inauguration on Monday. He's sending the vice premier instead. China's foreign ministry saying it wants a stable, healthy and sustainable relationship with the United States.
This is an olive branch. Xi Jinping is not coming, but he is sending a deputy and a high-level deputy. This is the vice president instead. Most usually, I mean, going back, I think, to the 1800s, only ambassadors show up, lower-level dignitaries. So it is interesting that China is willing to acquiesce to Trump's invitation and say, well, Xi Jinping can't come, and that would be a security nightmare, by the way, but we are going to send someone high-level. But, Jonathan, you hinted at this earlier. What is going to be, then, the path forward to negotiating with China? You're talking about 60% tariffs on Chinese imports. At the same time, you're saying, well, actually, we also want you to come for this big party.
I also think it's interesting, Isaac Boltansky of BTIG made the point that on the executive orders he's expecting next week, he thinks the focus will be on things like immigration. I think the market might take that as maybe a good sign that the focus won't be on trade. I would stress it's still early days, that they're still getting their ducks in order. And it looks like, and you've been reporting on this, that there still hasn't been an agreement on what the ultimate approach will be.
That's true. And some of these proposals have yet to even go in front of President-elect Donald Trump. We have to come back to the fact that there's competing differences, competing rivals within the Trump administration of individuals who, like Scott Bessent, thinks it to be a gradual approach, individuals like Howard Lutnick, who thinks you should go for a blanket approach. Peter Navarro is back. This is someone who's very critical on China and on trade.
Well, the market has shown a really substantial and impressive ability to kind of overlook all of that and just hope for the best. The fact that we've got this rally leading up into Monday, leading up into the inauguration, some 20 basis points. Yes, it's on the data. Yes, it's on Waller. But you don't really see that fear in market at this moment. Ian Lingen of BMO writes, maybe that this is just seen as an event risk, that we literally just need to get past Monday, whatever it may be, and then we can be off to the races with the bond market.
And it's not necessarily a bad thing for equities either when it comes to trade. Stocks have moved up and to the right since 2016. Even with a pandemic, we're a whole lot higher than we were back then. And the Democrats kept all of these tariffs anyway on China, and this economy is still doing pretty well.
What I found interesting was what Mr. Bessent was saying yesterday regarding tariffs. Maybe they'll use tariffs with adversaries more so than sanctions. And also, he did talk about that it can be both. You might use it as a negotiating tool, and for some countries, it might be a blanket.
Speaking of Bessent, appearing on track for confirmation after his Senate hearing in the last 24 hours, Bessent signaling full alignment with Trump, urging Congress to extend 2017 tax cuts and warning their expiration would mean an economic crisis. So I think we know where his focus is going to be on day one.
On tax policy is going to be huge because they have to extend these tax cuts or the rates go up. And that is why he said this is the single most important issue, pass, fail. It has to be dealt with this year. This is the timeline.
That's the focus for Bessent. Here's the focus for others. TikTok facing a Sunday deadline to find a new buyer. The Supreme Court expected to rule on the ban later on this morning. Trump's incoming national security advisor telling Fox News Trump will keep the app from going dark.
It's not even on the Trump team. It's Chuck Schumer, too. It is also the Democrats. Something that was bipartisan against TikTok existing.
I don't get it.
But it's TikTok calling their bluff. I mean, this is what it is, right? The amusing thing about Chuck Schumer was he wasn't necessarily saying, oh, I kind of backtrack. He just said, oh, we need to give TikTok more time to find a buyer. They've had since April of last year. Time is not the problem. TikTok doesn't want itself sell itself to an American buyer. They've put all of their eggs in one basket and trying to fight this law. And for now, it seems to be working.
Well, that's the executive order you can almost guarantee, because Mike Waltz, when he was on with Bret Baier, was talking about the fact that I don't want to get ahead of it, but we want to put a deal in place. It was so interesting hearing him really tone down his national security concerns of TikTok. He still says he still has them, but they want to find basically an off-ramp. I find this interesting. This is a little bit of Washington nuance, classic DC punt it. While no such deal is imminent, Biden administration officials have told Bloomberg that because the Sunday deadline is a holiday, in Martin Luther King Jr., it's a federal holiday, essentially that puts the enforcement to the next administration. Is that maybe just a little bit of fudging? What do you think?
I can't with these guys. There is zero consistency on this issue.
Can I just say Biden has shown no reluctance to issue orders and put in policy in the run-up to Trump, yet this is the one thing he's chosen not to.
This is the big one. It's TikTok. Apparently. Earnings season is well underway, with the biggest banks on Wall Street posting a clean sweep of beats. JPMorgan becoming the first bank in US history to top $50 billion in annual profit. Erika Najarian of UBS with the quote of the week: JPMorgan is a broken record, so to speak, but a broken record that consistently only plays melodies of revenue beats and forward upward revisions on profitability. Erika joins us now for more. Erika, welcome to the program. What stood out for you? What encouraged you the most about the year ahead?
Yeah, what really encouraged me about the year ahead is we heard a word that's not typically associated with banks, at least not for the past 15 years. It's the G word. It's the word growth. And so, you know, whether it's JPMorgan, who's been so consistent about this, or Bank of America, or even a Wells in a Citi, that quote melody of growth, not to be all dramatic about it, was really sort of playing consistently throughout earnings season. You heard that with Goldman and Morgan as well. So that was really unique because, you know, the story on these banks have been valuation, cycle, rates, and the fact that they're super excited and they have the excess capital to go forward in an economy and a capital markets that's this strong, that was really encouraging.
One of the things, Erika, it was across the board that earnings looked strong. Investment banking was no exception in that regard. It was fascinating that Wells Fargo also had such strong investment banking results. I think they had a growth of 59% of deals in the fourth quarter, a bank that traditionally isn't a big player here. What does that tell you, that Wells Fargo is getting into the action in a big way?
Yeah, it tells you really two things. Number one, I think Wells Fargo is a little bit undersold in terms of their ability to do that, because keep in mind, they're a top 3 lender to businesses in the United States. So they have all these balance sheet relationships. And, you know, in the past, they hadn't taken enough advantage of it. The second thing this tells you is that Charlie Scharf, that relatively new CEO, is doing the right thing. And he is not only trying to fix the company, but at the same time, really trying to invest back into revenue generating businesses. I think that's really good news all around.
If this had been a year ago, instead of optimism and deal making coming back in a new administration, the buzzword would have been AI. We got that maybe not in the earnings, but Erika, David Solomon had an interview with the FT where he said AI can now draft 95% of an S1 IPO perspective in minutes, a job that used to require a 6-person team multiple weeks. Is the AI productivity boom, is it here?
I'm not sure if the productivity part is here yet, but the investment part is here. So we had a meeting with Jamie Dimon in November, and he essentially said, look, AI is going to be inflationary for banks as we try to figure out what the best use cases are in our business before it becomes a productivity boom. But either way, I think Wall Street is eyes wide open in terms of what AI can do for their business and how it can eventually make them more productive and more efficient.
Erika, let's talk about the politics. Danny mentioned David Solomon. He said there's been a meaningful shift in CEO confidence, particularly following the results of the U.S. election, a.k.a. Donald Trump winning. How much is all this bank exuberance and excitement for 2025 down to policy in Washington?
I think it's not just policy, but supervisory. So, you know, in terms of what's more difficult to easiest to change, there's legislation, there's policy, and there's supervisory. And what got us kind of excited about near-term changes is, like I was saying in another program, while we were all, you know, wrapping gifts and watching Love Actually on the 23rd and 24th of December.
John's favorite
Matt
movie.
said Die Hard. Mine too. The Fed essentially put out a press release after the market closed on December 23rd that they were going to try to make the stress test more transparent in response to the Chevron ruling, or otherwise known as Loper versus Raimondo. And the day after, the bank sued them in terms of trying to get more transparency for the stress test. And I'm telling you, if we unlock capital or redefine excess capital for growth and for buybacks, that's really a game changer, because for the large banks especially, I've been on this program a lot talking about consolidation, but I think the market was saying, it's not going to get worse under Trump for the large banks. We hadn't really considered that things could get better, and those were signposts to me that things could actually get better.
Well, transfer of power will happen Monday in Washington, D.C. I caught you earlier this week with Shanali, and you said that JPMorgan has the best bench in banking. Erika, when do you think they'll start to tap that bench?
So, Jamie did say on Wednesday that he was probably going to be around for a couple of years. So that's probably the time horizon that we're looking at in terms of, JPMorgan potentially
what does a couple
announcing
mean,
a
though?
successor.
What's a couple?
Who knows, right? I mean, Jamie could be around forever.
It's not 5 years anymore. It's a few.
It's not 5 years anymore, he says. But again, could it? Here's my personal thesis. Go to 270 Park and observe sort of how quickly they're finishing that building. I'm not sure Jamie's going to leave until that building is all done and he cuts the ribbon.
Cut the ribbon. Call it Diamond Tower, and call it an end. Erika, appreciate your time.
Yes.
Erika Najarian
Absolutely.
of UBS. Just for the record, Hallmark movie kind of guy. Like single private equity executive in the big city, goes to rural America to restructure a bakery, falls in love, never comes back.
That's why I said Love
That's
Actually was more your speed. I'm more of the Die Hard fan around Christmas.
Die Hard.
Yeah.
I didn't actually get to watch Love Actually this time around. Next time.
I watch no Christmas movies. I think
Really?
I might be. Yeah, I think something about they're too melancholy for me.
I watched about 20 the month of December alone. Let's move on. What she said about Wells Fargo is important, by the way. Wells Fargo this week is up by close to 9%, the best week going back to 2023.
If people had written off this bank, especially when it comes to things like investment banking, a 59% increase in deal making in the fourth quarter, I think would have caught a lot of people by surprise. But Erika made a good point. This is a type of restructuring that they've been doing, which again begs the question, how much of these results are execution versus just a rising tide lifting all boats?
Erika's point, maybe it's not a single catalyst story anymore. Maybe things are changing. A bigger story for Wells Fargo. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief. Bloomberg is reporting that Rio Tinto and Glencore held early stage talks about a merger as recently as late last year. The talks are not currently active, and any transaction would face multiple hurdles, including antitrust scrutiny. Elsewhere, Bloomberg also reporting that NVIDIA CEO Jensen Huang will not be at Donald Trump's inauguration on Monday. There will be plenty of other high-profile US tech leaders there, including Apple's Tim Cook, Amazon's Jeff Bezos, Meta's Mark Zuckerberg, and Tesla's Elon Musk. The WEF has had a significant downgrade going into next week.
They're all going to be in Washington, D.C., freezing with me.
And finally, China's economy growing 5.4% at the final quarter of 2024. The jump bringing full-year growth to the country's 5% target. Annual consumption still falling below pre-pandemic levels, and deflation persisting for a second straight year. Exports boosting that number big time. And this is another story, together with a whole list of stories, that going into 2025 is very dependent on policy out of D.C.
Correct. If it's all about exports, then tariffs are going to be a problem. And if it's all about exports and tariffs come in, what happens to Europe then? If they need to continue this story on, the goods go somewhere else.
They front-loaded some of those orders too. They must have done, going into year-end.
Well, fair enough. And in the U.S., a lot of manufacturers there also front-loaded things as well. So it's happening on both sides.
Up next on the program, we'll talk trade, tariff threats boosting the U.S. dollar.
The American people should think about tariffs in three ways under the Trump administration: remedying unfair trade practices, a more generalized tariff as a revenue raiser. Tariffs can be used for negotiations.
Inflation is just around the corner. Live from New York City this morning. Good morning. Getting closer to the weekend. Equity futures here up by 0.4% on the S&P 500. In the bond market, bond yields down again. by 2 basis points, 4.59, off the back of the economic data and some dovish Fed speak from Governor Waller, which we'll talk about in just a moment. And the surveillance this morning, tariff threats boosting the US dollar.
The American people should think about tariffs in 3 ways under the Trump administration. 1 will be for remedying unfair trade practices. 2 may be for a more generalized tariff as a revenue raiser for the federal budget. And 3, sanctions may be driving countries out of the use of the U.S. dollar so that tariffs can be used for negotiations.
So here's the latest this morning. Markets bracing for President-elect Donald Trump's trade policies. The dollar hovering near 2-year highs as tariff uncertainty weighs on global currencies. Jane Foley of Rabobank writing, Trump may be prepared to back down on his previous preference for a weaker US dollar, particularly if he views that tariffs can do the heavy lifting on addressing the US trade imbalance. Jane joins us now for more. Jane, didn't work last time. Can it work this time?
Well, I think things are a little bit different this time. And I think we know Trump is an experienced politician. He's also, I think, ready to hit the ground running next week. And I think this time next week, we'll be able to answer that question with a lot more clarity, because if he comes through very quickly with executive orders, the market's going to get a very strong flavour as to whether or not what it's priced in terms of tariffs, in terms of growth, in terms of inflation, is really, broad-based correct or not.
Well, Jane, what do you think is behind the dollar move we've seen? Is it rate differentials off the back of superior economic growth and inferior growth abroad? Or is it really about anticipating the policy changes from the incoming administration?
It's both. Certainly, if we just take a snapshot of the US economy now and compare it with, for instance, Germany, China, what we see is a lot more strength. For instance, if you look at the forecast for growth in the US this year, they're averaging around about 2%. The consensus is around 2% for the US. It's about half of that for the Eurozone. Obviously, we all know that China's still got growth struggles, even though it did hit its target for 2024. So that there is a better growth outlook. And with that, there is evidence of sticky inflation in the US. So that's the snapshot right now. And on top of that, we need to layer in the potential inflationary impacts of tariffs, of mass deportations, for instance. That could certainly create a more tightness in the labour market, where a very significant proportion of the workers in the US are foreign born. Now, obviously, a lot of those have got documentation, but even so, we could certainly see some inflation or wage prices coming through in certain sectors, so agricultural workers, etc., and some others. So we do anticipate more inflation. The market is anticipating more inflation from Trump, but that's layered on top of what is a pretty robust economy already.
I understand these things are hard to disaggregate. Scott Bessent did take a run at it yesterday when he said for every 10% increase in tariffs, you would see a 4% move in currency markets. Jane, does that math square for you?
It is difficult because who are these tariffs going to be on? What about the tit-for-tat tariffs? There is so much to say. So it's very difficult, I think, to say with any certainty that that's exactly the rule of thumb that we can follow. But one thing that I think is going to be very, very interesting during this, the next few years under Trump is to what extent tariffs are used for foreign policy. Now, we had some indication from Bazinet yesterday saying that tariffs could be used for broader reasons. We had Trump a week or so ago in his press conference, talking about the economic power that he could exert on Canada, for instance. To what extent are we going to have this different type of statecraft really under Donald Trump, whereas tariffs are used not just for economic policy objectives in the US, but for foreign policy objectives in the US? And that is a different ballgame, which is very difficult to measure.
It's something Terry Haynes has been writing about at Pangea for some time. Jane, but it's for those uncertainties that you get something like the reporting we've heard out of the Bank of Japan, that officials there do and are leaning towards a hike at the end of next week, but want to wait until Monday, until we get Trump's inauguration, to understand what sort of executive actions he would take. What is the path that Trump might take that would either derail BOJ from hiking or give them the green light?
Well, I presume if Trump were to indicate that Japan was not in the center of the sights in terms of tariffs. But, Japan, I think, is in a very interesting, potentially quite a strong position, because we've got to remember that Japan not only is, the largest holder of U.S. treasuries outside of the U.S., but it's also the biggest provider of U.S. FDI. And of course, over the last, compared, say, to 30 years ago, the geopolitics between the U.S. and Japan have changed significantly. Whereas, in 30 or so years ago, the U.S. really forced Japan to move away from its semiconductor business if it was going to protect its manufacturing sector, and really forced Japan, to move large auto plants, for instance, into the US. Now, Japan sees itself more in certain areas, particularly tech, as more of a collaborator, and that relationship, I think, could be strengthened in areas as defense going forward. So those sorts of indication perhaps give Japan a little bit more strength in terms of the hand that it has got on offer to play against Donald Trump. So certainly not as vulnerable in terms of trade as perhaps China, maybe not even as vulnerable as Germany, for instance. But I think that's going to become a lot clearer over the next few weeks.
And also warming up to the president-elect, Japan will also be sending their foreign minister to the inauguration on Monday. Jane, I'd love to get your thoughts on one thing Scott Bessent said yesterday about sanctions. He said Trump thought that potentially the U.S. has gotten over its skis on sanctions because of de-dollarization. Do you think sanctions are leading to de-dollarization around the world?
Well, if we look purely at just the IMF data, there is not that evidence yet. In fact, if we look back over the last 20 years, there is evidence of de-dollarization. But actually, where central bank reserves have moved into other currencies, it has tended to be maybe the Aussie or the Canada currencies, perhaps, where over the last 20 years there has been some yield, for instance. So there isn't any firm evidence in the IMF data yet. But there does appear to be a logic behind the fact that if you are going to be applied by US sanctions, then it is in your incentive to stop using the US dollar. And we have seen, for instance, China set up its different payment system, for instance. We have seen some more spread of that between its trading allies. So it would appear logical that if you were to issue more and more sanctions, that you will eventually chase countries away from using the dollar. So there is, I think, a logic in that. And therefore, again, it comes back to how far can tariffs be used as a replacement? So this different type of statecraft where foreign policy aims can be used again by tariffs potentially, not just economic policy aims.
Jane, quickly, just before you go, help me out with something before you leave. How do you explain the difference between Governor Waller and President Hancock on the FOMC? Because the Cleveland Fed president is saying things like we still have an inflation problem. Monetary policy is only moderately restrictive. And Governor Waller came out in the last 24 hours signaling he's open to plenty of rate cuts in 25. What's that about?
Well, that is surprising, but certainly, we have this in the Bank of England too. We have this in the Bank of Japan. I mean, this is why there is a whole council, making policy decisions. We need all those different points of views. And of course, at the end of the day, it's which way the majority vote will go. And listening to many of the other Fed officials, it would certainly suggest to me that the majority is one of a cautious outlook now, leaving Waller perhaps as an outlier.
Jane, appreciate your time. As always, Jane Foley of Rabobank there on the FX market. We are poised. We're set for another week of dollar weakness, and only the second week of dollar weakness that we've had in around 4 months. I think we went through the whole of Q4 with only 1 week of dollar weakness, so that's one. This will be the second one.
A lot of it is due to the U.S. data over the past week. But again, how does this set us up for Monday? If we do get some real executive actions, does that mean we're going to get a pop in the dollar and pop in the yields higher? It's this kind of asymmetry we like to talk about.
I know I sound like a broken record now, but we'll see. Watch this space. I mean, it all comes down to next week in many ways for many of you I know. Up next on the programme, we'll catch up with Matt Miskin of John Hancock, Michael Townsend of Charles Schwab, Norman Roule of CSIS, and Mark Kelley of Stifel. The second hour of Bloomberg Surveillance. Next.
We are at a delicate point for the Fed, but I don't think they'll get too preemptive in this environment.
We came into this year with the thinking that inflation would probably hang at a level higher than what most market participants expected. We have one more rate cut kind of penciled into this year.
As it stands today, we're still looking at anywhere from 0 to 2 cuts this year. And the first cut in the second half of the year still seems likely.
The next round of cuts will likely need to come because they should.
How much lower can we really go on rates given where the Fed is and given where inflation is? I think that's the big question.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
If you came into this week bullish, you've had a great week. Everything's gone your way. The earnings from the big banks on Wall Street were decent. We had a downside surprise on CPI. On PPI, retail sales was okay. And Governor Waller was super dovish. And we're set for the biggest week of gains on the S&P since election week in early November. Equity futures adding some weight to the rally. We're higher by 0.3%. On the Nasdaq 100 up by a third as well. And likewise on the Russell going into the big one next week. Inauguration on Monday.
Well, I think Isaac said it best. We're going into fifth year of Trump, not the first year. We know the direction of travel on a number of issues like immigration, like energy, like deregulation, and like tariffs. The issue is we do not know the nuance of some of these policies, and that is really what the market is waiting to learn.
It's not clear we'll actually learn that come Monday either. That's one of the issues here. But if the market doesn't learn that, that might be a good thing because there is this anticipation being built up, especially after the rally of this week. This fear that we're going to get something that sets markets up. If we get past it and maybe we don't get details, it could be, hey, the event risk is past. We can go ahead and buy duration.
Big sigh of relief. We're buying duration right now. Yields are down across the curve on a 10-year and a 30-year. For a third consecutive day, we've got yields falling. Danny, we're down 2 or 3 basis points on 10s to 458.44. There are a lot of people on the street who have closed the door on the potential for a rate cut through 2025. Morgan Stanley's Mike Apen is not one. He says this: the door is still open to a March rate cut.
And you'd have to imagine that it is open after Governor Waller yesterday, too. I mean, really, really stunning. Just after the market had priced out the odds of a cut in the first half of the year, Waller coming out and saying if the data continues to look like it does, they'll be able to cut. Not improve, just continue. And I think we need to reiterate, CPI was 0.002% from being in line versus weaker than expected.
We could have been having a very, very different conversation. Going into the weekend, the quiet period begins, so no Fed speak through next week. I know many of you appreciate that. And then it's on to the following week when we get the Federal Reserve decision on the Wednesday at the end of this month. Feels like the last Fed decision was only last week. Time's flying. Equity futures on the S&P up by 0.25%. Coming up on the program, Matt Miskin of John Hancock as Wall Street awaits Trump's inauguration. Michael Townsend of Charles Schwab looking ahead to his first 100 days in office. And Mark Kelley of Stifel and a potential 11th hour rescue for TikTok. We begin this hour with stocks steady and bond yields moving lower. Investors focusing on President-elect Donald Trump's first day in office. Matt Miskin of John Hancock saying we are likely moving to a new macro regime here as we have to say goodbye to Goldilocks before the data was not too hot and not too cold, which left the Fed supportive to markets. Now the data is coming in hotter nearly across the board. Matt joins us now for more. Matt, welcome to the program. Did this week change things for you in any way, shape or form?
The Philly Fed index, John, was through the roof. I mean, it's a little too sunny in Philadelphia right now, it almost seems like. And when you see across the board, I mean, the NFIB survey also, I mean, some of these moves in the economic data almost look like meme stocks in terms of their parabolic upside. And when you see this, and then you hear the Fed, or FOMC members like Waller, as you've been addressing, saying they're still going to be cutting, it's hard to put those two pieces together. But at the end of the day, you got to position more for a reacceleration of growth. We're looking down in mid-cap stocks, industrials. We've been talking about them for a long time. But frankly, the earnings are looking good. They're starting to get more appreciation, relative strength. And if there's more onshoring CapEx, that's our favorite place to be in global equities.
So, Matt, let's build on that. How further down in market cap would you come? And would you go down to small caps? And let's just talk about the Russell. Can small caps work without interest rates coming down?
We don't believe so, John. And that is the big difference about reading this macro regime. It's almost like the macro regime playbook is missing pages here, or the pages are so dated you have to go back and get a new edition, because the small cap indices are just different than what they used to be 10, 20 years ago. Now, in a booming economy, 40% of the companies don't make money. And so they really actually would prefer a zero interest rate regime more than a strong economic regime. And mid-cap, on the other hand, 85, 90% are profitable. You're getting more industrial exposure. You're still getting financials, but that industrial exposure typically is higher quality with a higher ROE. So if you want quality and value combined, which is basically our mantra, quality at a reasonable price, we would go to mid-cap. Mid-cap may be the new small cap to implement for this kind of macro regime.
Matt, can I go back to what you're saying about data looking like meme stocks? Peter Scheer of Academy had basically the same read as you, but his conclusion was something is wrong with the data, that you can have a jobs report that comes in and 74 out of 75 economists have a number in expectation below 200,000, yet it surprises to the upside. Is there a factor that maybe the data, as hot as it's showing, is just not correct?
It could be. I mean, at the end of the day, these are surveys, and surveys have been the hardest thing to read over this whole cycle. Since COVID, basically surveys have been broken. Leading economic indicators, surveys that are trying to lead the economy have just frankly been wrong. They were overly pessimistic over the last couple of years as the economy chugged along pretty well, and now they've really whiplashed into more positive, kind of more optimist type outlooks. Now, does real GDP improve? Does other activity improve? We'll just have to see. But you've seen such a flip of the switch on survey data. At the end of the day, though, we're seeing it in markets. I mean, even just to start this year, I think in the best way, LL Cool J may have said it best, don't call it a comeback. You're seeing the markets rotate. Industrials, financials, materials are all starting to do better. Tech isn't working. I know this is like stunning for markets after 2 years of just tech domination, but a rotation's happening in markets, and that's reflecting probably what's happening in the economy, a better economic outcome.
I mean, you see that with an S&P that declines yesterday. Even so, 75% of the constituents of the S&P were up yesterday. The equal weighted is on track for its second best week over the past year. The only week that was better was after the inauguration of Donald Trump. Matt, how enduring is that broadening? Is that better breadth of the market?
We've been saying that it's got to be an earnings-driven rotation in financials this week. Now, they had low base effects. Q4 of 2023 is when the SVB payouts happened. So that really hurt Q4 of 2023 earnings. And then Q4 of 2024 earnings were strong on top of that. But investment banking, you were all just talking about this. Investment banking businesses are starting to come back and starting to get more strength. We're seeing, the yield curve steepen. That helps financials. Financials are the biggest value sector. It's really tech versus financials if you're trying to make a growth versus value decision, if you're going to see that rotation. But the great news of this week was really actually the fundamental side, and it was all those beats by the big banks.
You say that the Fed is likely done holding markets' hands. So then what do you make of Governor Waller yesterday?
To me, it was an outlier. And this is where it gets difficult listening to FOMC members because they're going to be all over the place. And if this divergence really happens over the next couple months, I don't think it really helps markets. It's just going to add uncertainty. But if you're data dependent, I don't get it. I mean, you just talked about how the CPI report beat by 0.002%. And trillions of dollars were moved across markets. And even in this little bit, as soon as inflation comes down a little bit, you get this speculative frenzy back in things like crypto. And that's not going to help your inflation problem or your kind of that speculative nature or sentiment of markets.
So Matt, let's address it. Can I just jump in? Is Governor Waller data dependent or is he Fed chair vacant seat dependent?
I think that's the latter. I think there's other motives. But, at the end of the day, over the course of the year, I think he could be right. I think the way we're looking at this is a two-half story for Fed in 2025. The first half, I think they have to be hawkish. I think they have to back off and let the economy settle in, see what happens. And in the back half, I do think they're going to be cutting. But it's hard to say right now, look, we're going to get it in the first half. I think you're just kind of bringing forward an inflationary impulse that you really would rather not have up front here as we're going to reset into the beginning of 2025. A lot of the inflation and commodities are coming back. That makes me a bit nervous on the inflation front, but it helps the cyclical side of equities, and that's what we're leaning into.
Well, Matt, let's stick with commodities for a minute. Scott Bessent yesterday took a moment to directly say if any Russian officials are watching his hearing right now, they should be on guard that potentially they will go after the biggest Russian oil producer, something we saw Biden do in the very last days of his administration. Did you get a sense that actually we're going to get a very hawkish Donald Trump administration when it comes to Russia and sanctions coming into office very shortly?
I did not see that on the 2025 bingo card. But, what we're seeing, yeah, you're right. I mean, and it's just interesting to see that the administration really waited to the end to kind of throw on these sanctions. And that is really where oil prices started to respond. Before, all the other sanctions or other supply issues was just kind of breezed over. I mean, WTI was more like $70. It's kind of breaking that. It almost looked like it was going to break down even further. And then it just really has rallied here. If you wanted disinflation, that oil rise is not good news. But at the end of the day, look, commodities work in these kind of short-term spurts. Even copper is ripping. I think this also has to do with getting ahead of the tariffs more broadly and just trying to get as much inventory, whether it's supplies, finished goods, ahead of this as possible. You've seen it in the China data. China's basically having this huge export data. They need the commodities to do it. But I don't know if it's really sustainable. Frankly, we believe inflation is going to come down over the course of the year. We think housing prices moderate. So we would actually use this impulse and lean against it, actually maybe grab a little bit of duration here.
I mean, it's a lot, Matt. And only the 17th day so far of 2025. You'd think people would welcome a long weekend, but everybody's going to be glued to their screens waiting to see what happens on Monday in terms of executive orders. What's your read on how vulnerable the market is to any sort of action from Trump, be it on immigration or tariffs?
Right now, we're pricing in a lot of good news, and sentiment has really skyrocketed to be more positive. I think more broadly, what we're seeing is the biggest liability to this market is the positive sentiment. One of the best things this markets had going in to the last year or so was that it was pretty bearish. And the new administration has brought a lot of hope, a lot of optimism. Not necessarily a bad thing. Again, that's probably driven some economic activity and more CapEx, deregulation, all that. But at the same time, you got to be careful here, looking for everything to go right and thinking that it's all going to be kind of an easy way to navigate this macro backdrop. There is still policies that could kind of dent some economic growth. There is policies that could create volatility. So at the end of the day, you still got to think about risk management. And again, that would bring us to the bond market.
Matt Miskin, making tears rain down like a monsoon. Appreciate it, sir. Of John Hancock. Yes, LL Cool J. I wasn't expecting that. LL Cool J lyrics from Matt Miskin.
I mean, it's TGIF. It's Friday, so why not?
Were you expecting It's Always Sunny in Philadelphia
I
reference?
wanted to, listen to the bass go boom explosion and then, anyway. All right, let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief. TikTok looking poised to win a reprieve from a US ban. President-elect Donald Trump's team promising to give the Chinese owner more time to divest. Monday's White House transition effectively gives Trump's administration control over whether a ban is enforced. Elsewhere, Starbucks China chair Belinda Wong is retiring on January 24th. The CEO, Brian Niccol, crediting Wong with transforming Starbucks China into the company's largest international market. Wong's departure coming amid a global management reshuffling at the company. And finally, a concert to raise money for the Los Angeles wildfire victims will be held on January 30th. It will be broadcast on multiple streaming services as well as in select AMC theaters. Billie Eilish, Lady Gaga and the Red Hot Chili Peppers are among those expected to perform. And that is your Bloomberg Brief. Up next on the program, markets bracing for day one.
On day one, we will begin the largest deportation operation in American history. I will also terminate the Biden-Harris electric vehicle mandate on day one.
Day one is just around the corner. Live from New York City this morning. Good morning. Stocks doing okay here, positive by 1/3% on the S&P 500. Bond yields down 2. We're down by 3 basis points. The 10-year 458.24. Under surveillance this morning, markets bracing for day one.
On day one, we will begin the largest deportation operation in American history. I will also terminate the Biden-Harris electric vehicle mandate on day one and save the U.S. auto industry from destruction. That means two things on day one, right? drill, baby, drill, and close our borders.
So here's the latest this morning. Traders gearing up for President-elect Donald Trump's return to the White House with major policy changes expected as early as Monday. Michael Townsend of Charles Schwab writing, market volatility may increase around reports of what is or is not included in executive orders and proposals. A well-diversified portfolio will remain appropriate as a busy year in Washington unfolds. Michael joins us now for more. Michael, you heard that sound there. That was the President-elect Donald Trump back in the summer, I think back in July, I believe. How different will day one be to what he was saying on the campaign?
Well, first of all, I think it's going to be really cold here for inauguration. So if you're coming to Washington, bundle up. It's going to be the coldest inauguration in 40 years. But beyond that, I think it's going to be interesting to see, how much can get done on day one, because there's an awful long list that was promised on day one, and I'm not sure there are enough hours in the day to make that happen. But obviously, investors, markets, companies really watching for the details on tariffs and on immigration in particular. So I think everyone is kind of on pins and needles to wait and see what the details are and whether they're, as extreme as the language has been on the campaign.
Michael, thank you. I will pack my base layers. I heard it's going to be cold. I appreciate the tip. Let's talk about the tariffs, because that is really where the uncertainty is. What is the scope that you think Donald Trump is willing to go early on when it comes to tariffs on, say, China, Europe, Canada, Mexico?
Yeah, I think it's been really interesting because all along here in Washington, I feel like there's been this kind of assumption that we're going to put tariffs on absolutely everything was sort of a rhetorical flourish, that there's probably going to be more nuance to it. But now, you talk to people inside the campaign and the transition, they're talking shock and awe on day one. So I think there's some real uncertainty about how far reaching they'll be. There's been talk about whether maybe there'll be some sort of scaling up. They'll start kind of small and then accelerate over time. It's all speculation. I think we need to see the details. And that's why it's been so difficult, I think, for companies to plan and really think about how they're going to react until we see the details.
Well, we know the future Treasury Secretary thinks about tariffs, Scott Bessent. What I'm confused about is who's going to be the most hawkish in the administration, because the real tariff man, Mr. Lighthizer, Ambassador Lighthizer, is not joining Trump 2.0.
Yeah, that's absolutely right. And I think Scott Bessent yesterday in his confirmation hearing, clearly he's planning to pick up the mantle there. But, what I think is really interesting about the administration picks is that the economic team, and I'm talking Scott Bessent at Treasury, Howard Lutnick at Commerce, you can add in Paul Atkins at the SEC. These picks are really much more sort of mainstream than some of the extreme picks that we're seeing in other areas. And I think that's really reflective of how Donald Trump feels about the economy, feels about the markets. The one thing he doesn't want to happen is anything that damages the economy and damages the markets and sends the markets down. So I think here in Washington and I think on Wall Street, there's some level of comfort with these picks that they're going to be
Peter
thoughtful.
Navarro?
Peter Navarro, maybe not quite in that same category, but I do think generally that there's the most extreme picks seem to be in other areas of the government, and I think Wall Street is at least somewhat comforted by that.
Let's also discuss tax policy. Bessent said yesterday it's the single most important economic issue of the day. This is pass-fail because there's a deadline. How do you see the process playing out on Capitol Hill?
Yeah, I think the process is going to be really, really complicated. And I've been saying to people all along that the thing to watch here is the House of Representatives. You've got what will effectively be a one-vote majority for Republicans. That basically gives every House Republican a veto, at least until special elections are held in April to fill a couple of the vacancies. So I think this is going to be incredibly complicated to keep all House Republicans on the same page. We've seen over the last couple of years that they really struggle staying on the same page. All that said, I do think the tax cuts, the expiring tax cuts, get extended by the end of the year. The real question is what else is added to that. Here in Washington, we're hearing a lot about the no tax on tip income has some momentum. And then the other piece is how do you pay for it all? There are a lot of folks on the House Republican side who are really, really concerned about the debt and the deficit. And, their vote is not guaranteed until the details are finalized.
That speaks to this idea, Michael, that the harder thing to work out is going to be taxes, is going to be the thing that the market has used to reignite the animal spirits. And instead, as you first started talking about, day one looks like it will be things like immigration and tariffs. In conversations with clients, how sanguine are they? Are they prepared for that reality that you're describing?
I think they're prepared. I think that, first of all, I think there's an assumption that the taxes that are expiring will get extended. But I think there's a lot of uncertainty about how big this gigantic bill can be. I mean, if you're going to put taxes and potentially the debt ceiling and government spending reductions and energy policy and you name it into one gigantic bill, the risk of that collapsing of its own weight is pretty high. So I think there's going to be a lot more twists and turns. This is not going to be a straight line to the tax cuts being extended. I also think it's going to take longer than a lot of people assume. You know, the idea that it's going to get done here by late spring or something like that, I think that's a real stretch. I think we're going to be much farther into the year before this gigantic bill comes together.
Michael, what's going to be Elon Musk's role in all of this? Because we have seen a Musk, especially during confirmation hearings, who's been able to hold the idea that he will primary people who don't go along with Trump. He will donate to those that are running against them. Do you think that could act as sort of a stick in these negotiations as Trump tries to coalesce people together around one big, beautiful bill?
Oh, I think there's no question. You know, what's the most important thing to these guys? Getting reelected. So they're always going to have that in mind. I think it's going to be really interesting to see how Elon Musk's role in the new government sort of unfolds over time. There's a lot of ego there. There's a lot of ego, obviously, with Donald Trump. Those two clashing at some point, I think, is all but a given. And, keep in mind that Elon Musk's role in this DOGE, the Department of Government Efficiency, doesn't have any actual power to do anything. It can only make recommendations. And once you get to recommendations for cuts, well, there's 435 members of Congress who have things going on in their district that they want to protect. And it gets much more complicated. So I think it's going to be one of the most interesting things of this first year of Trump 2.0 to see how the Elon Musk relationship pans out.
Michael, I think you're questioning how close they actually are. Do you think some distance will be put between Trump when he's in the Oval Office with Musk?
Yeah, well, obviously we'll have to see. We don't know. I just think these are two incredibly strong personalities, and that at some point, President Trump may get a little frustrated with Elon Musk's, time in the spotlight. But I do think that he sees him as a partner. I think he sees him as someone who has a long business experience of making hard decisions, and that's what Donald Trump thinks is needed to get spending down. So I think there's a chance that this works, but I think the chance of a flare-up is fairly high.
Hey, Michael, appreciate your opinion and perspective. Thank you, sir. Michael Townsend there of Charles Schwab. I know where you're going. Will Susie Wiles put some distance between them?
Well, I think so. And if you look at a recent interview she gave with the New York Times, she was talking about basically making sure that there is a process, that the staff that are promoted to do their jobs will be the ones carrying out. I think there would be a concern if you're, say, Marco Rubio, and Elon Musk is talking about German politics, or Nigel Farage, or China, or Giorgia Meloni and Starlink. They don't want every question at their press briefings to be about something Musk says, only because he has this proximity to power, which is the president.
Day one. Monday. Equity futures this Friday morning, and good morning to you. Positive by 0.4% on the S&P 500. Supported this week by better than expected earnings coming from Wall Street. Better than expected data as well. A downside surprise on CPI. Some dovish Fed speak, which ignited a bond market rally too. Bond yields are lower by more than 10 basis points on a 10-year. Yields this morning are down another 4. We're down to 4.57 on a 10-year yield. Up next on the programme, we'll catch up with Norman Roule of CSIS with an Israel-Hamas ceasefire on track to begin on Sunday. From New York City, this is Bloomberg. Equity futures right now, adding to the week's gains. We're up by 1/3 on the S&P, call it 0.5 on the Nasdaq. Struggled to build on a 3-day winning streak in yesterday's session, but we take back yesterday's losses already this morning. Encouraged by the earnings, by the economic data, and some dovish Fed speak. With 2 hours until the opening bell, let's get you some morning movers. Here's Manus Cranny. Good morning, Manus.
Jonathan, good morning. Let's kick it off in the chip sector. Barclays note comes out. They talk about the sector and Broadcom. Broadcom, they raised the price target to $260, so a little bit above here. It originally was $205. They keep it as an overweight. They like the capital expenditure overall in the market. But here's the rub. When it comes to artificial intelligence, there are going to be the have and the have-nots. And this is where the struggle comes for Barclays. It's going to be tougher to get more positive on cyclical semiconductors, analog PC, and handsets. So they're questioning the strength of 2025, which then takes me into Apple. Bear this in mind. Apple was down 4% yesterday. Apple is down nearly 9% so far this month. They had a holiday season they would prefer to forget. So why focus on a stock barely up 0.7%? Because you're almost at a correction in Apple. Evercore pop it onto their tactical outperform list with a price target of 250. They are leaning into the fact that China remains the wild card. China, there you go. What will the tariffs be? What will the carve-outs be? What is your risk there? But you've got to lean into the iPhone 17 as another, perhaps being a little bit better than feared. But it just struck me, down nearly 9% so far in January is a pretty sizable change in price. JB Hunt slides, this is the transport company, down 9%. $1.53, way lighter than the market had estimated on earnings per share at 1.63. But it's the depth of the miss that Citi flag up first. They're skeptical that you're going to see an inflection point in rates. And Bloomberg Intelligence have run their numbers. They reckon you're going to see a sequential EBIT decline of around 20 to 25% in this. Jonathan.
Manus, thank you, sir. Let's start getting hammered. Out of surveillance this morning, President-elect Donald Trump telling Senate Republicans he won't wait on them to implement policy. The Wall Street Journal reporting Trump has prepared roughly 100 executive orders, saying he's ready to press the limits of presidential authority to go it alone on issues like immigration. The reporting from the Journal echoing what we've been reporting over the past week or so.
That's right. We're going to have about 100 executive orders in the first few days. I've heard all the quips from members of the incoming administration that his hand's going to start to hurt. He's going to need a number of Sharpie pens, which we know he likes to sign his signature with, in the 48, 72 hours. The issue is when it comes to certain policies that he wants to enact, he cannot go it alone. And I'm clearly thinking about the tax policy. TCJA, he talks about, was this historic legislation under Trump 1.0. You cannot extend that through executive order. He's going to have to play ball with Congress.
And of course, the issue with that, the things that he needs to play ball with Congress, the things that would take more time, be it taxes or deregulation, are the things that this market wants, are the things that presumably help lower inflation. You guys have talked about this so much around this desk, this idea that sequencing matters. If what we get first is tariffs and immigration, those are more inflationary policies, and you don't get the benefit of deregulation until sometime in the future.
That's why we keep saying we're encouraged by the news so far this week, but still nervous about what's going to come next week. Let's talk about a deal, the potential for a big deal. Rio Tinto and Glencore holding early-stage talks about combining their businesses in what would be the largest ever mining deal, rivaling long-standing industry giant BHP. Sources telling Bloomberg the discussions took place as recently as late 2024, but are not currently active. This is a potential deal we talked about a decade ago, and I'd make 2 points. One's on assets, and a second one's on culture. On assets, Rio Tinto's been trying to get out of the likes of coal. Glencore's been getting into it. In fact, I believe they took some Rio assets over the last number of years from Rio. Rio has been built on the iron ore boom and the construction boom in China. They've been trying to lean into things like copper. I understand that Glencore has the copper assets, and maybe that's what they're going for here. But then you involve culture. You start to think about a combination. I can't think of two more different cultures within a sector, Glencore versus Rio.
Just their history alone, right? Glencore starts as a swashbuckling trading commodity outlet in this Wild West. Rio Tinto had maybe a more classic start of miner, and I think that really imbues their cultures to begin with. M&A is always really, really difficult. Culture is always a problem. But this is a clash, I think, on epic proportions. So a lot of people looked at this deal and said it makes sense that it fell apart because there's not a lot of logic to it.
That's before we even get into antitrust issues. But watch this space. Maybe it hasn't completely fallen apart, but pretty remarkable that that deal came back on a table after exploring the same thing about a decade ago. Let's turn to an important story. Israeli Prime Minister Benjamin Netanyahu saying a ceasefire agreement with Hamas is on track to begin on Sunday. His security cabinet saying this morning a hostage release also expected pending approvals. Bloomberg's Ollie Crook joins us now from Tel Aviv. Ollie, good morning. And what's the latest?
Yeah, so listen, John, even in the first 24 hours of this deal being announced on Wednesday night, there were some stumbling blocks between the Israeli government and Hamas leadership. Those seem to have been resolved this morning. Where this sits this morning is with the Security Cabinet. They have been meeting now for over 4 hours, and this is trying to get approval from the Israeli government to put this ceasefire deal into action. The difficulty that the government is going to have here is that Benjamin Netanyahu's party has been supported by a number of right-wing parties here who have in fact threatened to leave the coalition government if they pass this deal through, because they want to continue to prosecute the war until basically the entire eradication of Hamas. It seems that even if they were going to do that, that they could still pass this deal with a minority government. Plus, there is so much will within the Israeli population. You get off the plane here, it's the first thing you see at the airport, the posters of all the hostages that are led. There are stickers all over town. There is huge, immense will to get this over the line. And if you do get it over the line through the Security Cabinet and then the cabinet vote a little bit later today, you will get that first exchange of hostages. That ceasefire will take place on Sunday for 6 weeks. You will get 3 female hostages, a total of 33 to be distributed over that 6-week period. In return for that, you will begin to have the prisoner released from the Israeli side that are held the Palestinians. And really what you're going to get also is, of course, a cessation of fighting within Gaza and a withdrawal of Israeli troops, not out of Gaza, but down the eastern corridor. And critically, John, the other sort of element here, more than 45,000 people have been killed so far in Gaza. The infrastructure is completely shot. This will allow huge volumes of aid to finally pour back into Gaza, which is in desperate need of that at the moment right now.
Oliver, let's talk about the hostages. I'm told 24 of the 33 are alive, and I'm told about 9 or 10 of them are in either wounded, seriously wounded, or ill. Like, the conditions these individuals are going to come out in is not going to be good. At what point can we see all of the hostages be freed from Gaza?
So listen, let's talk about the sequencing here. What we're going to get in the first wave here are going to be the release of mostly women, elderly, and wounded. It is very hard to appraise at this time how many of the hostages are still alive, how many of it is going to be the corpses that are being returned to Israel. In terms of the sequencing, there are 98 hostages that remain. 33 will be sort of released in this first part of the ceasefire agreement. But remember, this is an agreement that has 3 parts by the sort of architects of this that brokered the deal: Qatar, the United States, and Egypt. What they would like to do is, after this sort of first phase, is to go further into the second phase, but that is going to be basically what Biden has called the actual end of this war. As difficult as it has been to get to phase 1 here, we've been in this war for more than 400 days, more than a year and 3 months. It is actually going to probably be harder to get past phase 1 into phase 2, despite the fact that by the brokers of this deal is supposed to be not just a ceasefire for 6 weeks. This is supposed to be the architecture of the end of the war. What this will now open, though, are the very, very challenging questions that are really at the heart of this conflict, not just for the last year and a half, but for the last decades. Who is going to oversee security over Gaza? Who is going to ensure that there is a government there that both represents the people of the Palestinians in Gaza while also sort of preserving the Israeli guarantees? That is really at the heart of the question here as to whether or not there's going to be any more progress past this first phase.
Ollie, appreciate the update. Thank you, sir. Bloomberg's Oliver Crook in Tel Aviv. Elsewhere, former senior U.S. intelligence official Norman Roule writing the following: the execution of the agreement will likely take longer than the 4 months described in the deal, with opponents among the Israelis and Palestinians who must be managed to ensure the agreement doesn't collapse. Norm joins us now for more. Norm, as always, a great deal of amount of respect for your perspective and your opinion on the matter. Could you just share with us whether you think this agreement will hold, it won't collapse?
Good morning. It is very likely to hold and to take place. The deal is a cause for celebration by the families of the 24 hostages will be released, and will bring some element of closure as the remains of 9 other hostages are returned to their families. But importantly, the Palestinians see an end to violence, so they will be able to begin a very long road to reconstruct their lives. So there's drivers on each side for this initial deal to take place. But in the longer term, moving to the second phase, as you discussed in your previous segment, it's challenging. And because all hostage deals come with cost, Hamas and Hezbollah are no longer strategic threats, but sufficient elements of each organization remain that can be rebuilt. And Iran hopes to do exactly that. Israel's about to release hundreds of prisoners, many of whom were convicted of serious terrorism crimes. Some of them will return to terrorism. Israel reportedly is also about to release some settlers who were convicted of anti-Palestinian violence, and that will create trouble. So in many ways, what we're watching is relief, a good first step, but a beginning of a very long road. And importantly, the Trump administration, which played a huge role in the success, will now need an architecture to manage and sustain this momentum.
Well, let's talk about the Trump administration. The incoming officials, Steve Witkoff, Morgan Ortagus, were brought into helping get this deal over the finish line, working alongside the likes of Brett McGurk, who's basically been camping out, Norm, in Doha, working on the framework. Who do you think gets the credit for putting this over the finish line?
Well, everyone does, but there's a formula by which this succeeded. First, you had significant work by diplomats on all sides to develop a framework. But that framework was unlikely to have been executed under the Biden administration had it not been for Israel's destruction of Hamas and Hezbollah leadership, which the Biden administration often publicly opposed in terms of the operations. But even then, it is unlikely this would have happened without President-elect Trump's profoundly hard statements, his involvement in the process, and sending Steve Witkoff, who, according to many reports, has been masterful in his handling of both the Palestinians and the Israelis. So there's a formula here that required all three pieces to make this a success.
What about the remaining hostages? Not the 33 that are going to be released starting on Sunday. Do you think Steve Witkoff and the incoming Trump administration can get those remaining hostages out of Gaza?
It's a possibility, but again, we're looking at the second phase of this deal. That's going to be hostage to elements in the Israeli right who, even if they agree to the first phase, do so only because there's a belief that the second phase will involve further military operations to destroy Hamas. It also involves Hamas not undertaking kinetic operations against Israel, and there are multiple violent actors within the remaining Hamas organization who are likely to do so. So it's going to be a challenge. It's going to take a lot longer than I think some people perceive, and it's going to, again, be critical that we have a system and a team to keep this pressure on all sides.
And Norm, even beyond that, there is still no clarity in who runs Gaza once we get through these different phases. Netanyahu hasn't presented any type of plan. There's clearly no appetite to allow Hamas to continue to run the Gaza Strip. What is a possible alternative for this region?
There are no possible alternatives that are seen at this time. The good news is Israel is demonstrating it wishes to withdraw from the Gaza Strip. It does not seek to occupy this permanently. The bad news is Hamas fighters remain in their thousands. They're disorganized. They lack leadership, but they have the guns. They're going to want to control the aid and its distribution. So who pushes back on these Hamas fighters and the criminal gangs, which have hijacked a fair amount of aid in recent months, is not only an open question, but we actually have part of the answer. There isn't anyone yet there to do that. And that opens the prospect of Hamas reconstituting itself and this process, in essence, beginning all over again in the long term.
Norman, I mean, is it just fair to say, though, that this conflict is just far from over, years from being over even?
Absolutely. This will require, ending this conflict will require first the Israelis agreeing to a two-state solution, but also the Palestinians demonstrating that two-state solution won't leave Hamas in charge of that state, not only against on the borders of Israel, but on the borders of Jordan. And the Palestinian Authority has been a relatively sidelined element in this entire negotiating process, and they have not demonstrated they have the capacity yet to provide security and the governance that Gaza needs. If an election took place today in the West Bank and Gaza, Hamas is likely going to be the winner.
Norman, appreciate your perspective, sir, as always, and your time. Thank you. Norman Roule there of CSIS. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief, and let's kick it off where we left off. Yemen-based Houthis signaling a pause in attacks on commercial ships following the Israel-Hamas ceasefire deal. The Houthis leader saying they will follow the agreement, but leaving the door open for resuming attacks. Elsewhere, New York City Mayor Eric Adams meeting with President-elect Donald Trump in Mar-a-Lago today. Differing from many in his party, the mayor expressing support in deporting violent criminals and cooperating with federal law enforcement on immigration. And finally, Citi cutting more jobs this week. People familiar with the matter telling Bloomberg managing directors in the wealth business and technology unit are leaving. The bank also cutting a data team. The reductions come as part of CEO Jane Fraser's push to cut costs. That right there is your Bloomberg brief, and that is not the only time we've seen a story like that. over the past week. How much longer can we sit here and just say, well, that's idiosyncratic, that's Citi specific, that's Wells specific, that's JPMorgan specific?
Slew of stories, and not just in the banking sector. Meta, Microsoft, we've seen a number of companies come out and say we are actually going to trim some of our workforce.
It's not even just cutting jobs, it's taking away benefits. Citi already lowered 401k. Things like, finally pet leave apparently was a thing, is getting taken away too. It's not just outright firing people, but it's kind of saying...
Hold up. I didn't know pet leave was a thing.
There was a Wall Street Journal story that apparently pet leave was a thing at some companies and they're finally taking it away.
This is what happens when HR is running companies and not founders.
So what happens? I have to get a dog and then I can have a day off?
Yeah, it's like paternity leave.
That's actually a thing?
Yeah, apparently some companies it was a thing.
When you first get a puppy, you can take time off.
Or if your dog or cat or, I don't know, dragon gets sick. Hamster, you could take time off and make sure you're there to hold its paw at the vet.
I'm getting a hamster this weekend, and I'm going to take the next 3 months off.
I thought you were going to get a little French bulldog.
How long do you get off? Just out of interest.
I don't know.
Who's doing this? Where do I sign up?
Taking care of a puppy is hard work, I guess. I don't know. I guess we'll see you in a month, John. Good luck with your hamster.
Up next on the program, TikTok's 11th hour.
We'll either close up TikTok in this country for security reasons, or it'll be sold. We did go on TikTok, and we had a great response with billions of views. They said, maybe we got to keep this sucker around a little while.
That conversation up next, live from New York. You're watching Bloomberg Surveillance. Live from New York City, welcome to the program. If you are just joining us, stocks higher by a third of 1% on the S&P 500. Bonds rallying once again, yields lower by 3 basis points this time, the 10-year 458.24. Under surveillance this morning, TikTok's 11th hour.
We'll either close up TikTok in this country for security reasons, or it'll be sold. I have a warm spot in my heart for TikTok because I won youth by 34 points. And there are those that say that TikTok has something to do with it. We did go on TikTok, and we had a great response with billions of views. They said, maybe we got to keep this sucker around a little while.
So here's the latest this morning. A Supreme Court ruling expected today on TikTok's ban in the United States. The app is facing a Sunday deadline to find a buyer. The Washington Post reporting President-elect Donald Trump is considering an executive order to delay the ban. Mark Kelley of Stifel writing this: if the ban is enacted without reversal, we see Meta, Alphabet and Snap as the biggest beneficiaries. We'd expect Meta with Reels and Alphabet with YouTube Shorts to receive the majority of reallocated ad dollars. Mark joins us now for more. Mark, welcome to the program. There are the potential consequences. What's your base case for what happens later today from the Supreme Court and this Sunday?
Good morning. Thanks for having me. My base case is that this gets pushed out again. And we're seeing that on both sides of the aisle. So you've got, Senator Ed Markey in Massachusetts, who's been trying to push for an extension. And now we're seeing it from the Biden administration as well. So I think it gets pushed out again. And frankly, that's what we've been hearing from the advertising community is that overall, no one was really expecting a ban, to take effect.
When it comes to the Supreme Court, and you think your base case, they will likely uphold the law, do you think it's changed, given some of the politics have changed in the last even just 48 hours?
Yeah, I think, honestly, my base case before Friday, when that TikTok hearing didn't go well for TikTok, my base case was that the platform would not be banned. And I say that because, a lot of folks talk about the, security threat that, TikTok perhaps poses. I would say if it was such a big threat, I would hope our government wouldn't let TikTok kind of operate as is through the election for such a long period of time. So, I wonder what that threat is. I'm not saying that it isn't a threat. It just having more clarity, would be important, I think.
So what happens now in terms of who could potentially take this company over? What do you make of reporting? We've had a scoop here at Bloomberg that Chinese officials are looking at potentially Elon Musk as being the #1 choice to run this company.
Yeah, I think, what's important with any divestiture is what comes with, the TikTok business. ByteDance has been very clear that they will not part ways or give parts of the algorithm to a potential buyer. So, it begs the question, what are you actually buying? You're buying 170 million, roughly, U.S. users. You're buying the shell of an app, but you really don't have, the algorithm and the tech in the background to power that platform. So Elon Musk as a suggestion does make some sense to me, given what he's done with Twitter and X. And I think if he was the acquirer, I think he's well equipped to handle whatever situation is thrown at him.
Well, Mark, part of the reason that TikTok's not going to go dark on Sunday is because President Biden has said that he won't enforce the ban and he'll leave it to the Trump administration. But literally on everything else, when it comes to Cuba sanctions, when it comes to Russia sanctions, various laws, the Biden administration has shown a willingness to do things in the final days until President Trump takes over. Why do you think on this one issue, it's something that Biden has decided to pass along?
I'm not a political analyst, so I don't want to get too deep in the weeds there. But I do think, again, both sides of the aisle, throughout the election cycle, everyone up for re-election had a presence on TikTok, while also saying that it poses a national security threat. Yes, you highlighted at the outset, that Trump did well with younger users, particularly men, I think, on TikTok. But so did the other, side of the house as well. So I do think a lot of what we heard on Capitol Hill was probably a lot of posturing, last year when they called the TikTok CEO in front of Congress a couple different times. I think a lot of grandstanding there. And at the end of the day, I think we all kind of need to know, what is this national security threat, if it is an actual security threat. So I think throughout this whole process, there have been, support and also folks that are very skeptical of TikTok, again, on both parties.
Mark, just before you go, I'd love your comments, your thoughts on the Zuckerberg conversion, turning up to the inauguration on Monday, changing the way they censor, stripping out the liberal bias from maybe the way they operate on the West Coast. Mark, do you think it's going to drive engagement? Will it push up ad dollars?
For Meta, I think if we use the election as a proxy for what the overwhelming majority of folks in this country prefer, I think they would like some unfiltered news and community notes. I've been on X quite a bit. I would say, in my opinion, community notes look like they're working pretty well. So if it works as well on Facebook and Instagram, I think that's great. I do think Meta is probably, I don't want to say worried, that's not the right word, but they want to make sure that the advertising environment is a good one, where people feel comfortable that the content isn't offensive, it aligns with your brand. And they have a couple third-party partners, Double Verify and Integral Ad Science, that they partner with to give people some of that comfort. And there's a product in particular that Meta was slated to come out at the end of this year that they actually brought forward to the, essentially Q1 of this year. So I think, to me, that tells me that Meta has been contemplating this move, particularly on the content moderation side for a bit, and brought in, those partners a little bit earlier.
Hey, Mark, appreciate your time and your opinion. Thank you, sir. Mark Kelley there of Stifel. The latest on TikTok. We should hear from the Supreme Court potentially later on this morning. Up next, in the third hour of Bloomberg Surveillance, we'll catch up with Jim Caron of Morgan Stanley, Jason Bazinet of Citi, looking ahead to Netflix results, Steve Ricchiuto of Mizuho, why he thinks no rate cuts in 2025, even with that CPI print earlier this week. And we'll get the thoughts of Phil Camporeale of JPMorgan Asset Management on the latest in this market. The latest right now, equity futures positive on the S&P by 1/3 from New York. You're watching Bloomberg TV.
Markets pricing in just the right stuff coming out of D.C.
We've always viewed policy as either an accelerant or a dampener. By itself, it rarely makes trend.
The engine of the car, being the consumer, looks completely fine. Is it going to get turbocharged by some of these policies? I think that's probably a risk that we can't dismiss.
We're in this really sensitive period of time right now. The markets are really walking on pins and needles.
There are these exogenous shocks that are going to disrupt the cycle that we're currently in. We don't know the probability and we don't know the size of them, but we know that they are coming.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
So technically it's a long weekend stateside, but on Monday, a lot of people on Wall Street will be at work. It is day one of the Trump presidency just around the corner. Equity futures going into the weekend positive by 0.4% on the S&P 500, poised for the first weekly gain of the year so far in 2025 on the S&P 500. On the Nasdaq, up by 0.5, on a Russell, up by 0.6. In the bond market, yields down once again. For the longest daily streak, going all the way back to early December, we're down another 4 on a 10-year. We're down 5 on 30s, encouraged not just by the economic data, but also by a very dovish Governor Waller.
Governor Waller saying yesterday that there is a potential, if the data continues as it has been, to get a cut in the first half of the year. That is quite the low bar. We've been saying the CPI ended up coming in lower than expectations by 0.002%. The market has taken it in stride, even though Waller does sound like an outlier, even though there's this idea that he's campaigning for Fed chair. But John, I go back to the idea that both can be true. He can be a dove, and he can be hoping that he gets the next chairmanship.
If the data allows them. Frances Donald, RBC, sat around this table yesterday. You heard from her just moments ago. She thinks the data won't. As she thinks the policy changes you're about to see will keep this economy running hot, and maybe with an inflationary impulse, which will keep this Federal Reserve on the back foot.
And we've seen the market price in Trump 2.0 at the start after the election, but even for some firms, it's been before the election. They thought he was going to win, and people put these bets on. Next week, we can actually see what sticks from the policy proposals we've heard on the campaign trail. And that is when we are going to get a slew of executive orders over the first 48 and 72 hours. And then also potentially all these stories about these competing narratives on tariffs. What gets presented to the president and what does he decide on?
Coming up this hour, Jim Caron of Morgan Stanley. As this equity rally takes just a little bit of a breather, Jason Bazinet of Citi looking ahead to Netflix earnings, and Steve Ricchiuto of Mizuho on why he sees no chance of rate cuts through 2025. We begin this hour with stock steady, investors pausing ahead of President-elect Donald Trump's inauguration. Jim Caron of Morgan Stanley saying, ask not why yields are rising, but why the yield curve is steepening. Context matters. There is no magic level. But when yields stop rising and plateau at a level that competes with equity returns, this is substantive. But yields need to stop rising first. Jim joins us now for more. Jim, a few days of it. Are you confident enough that we have stopped rising?
No, I'm not. I actually think that we're going to be in a range. I think the range is probably 4.25% on the 10-year up to 4.75%. And I think that we can overshoot a little bit to the upside. I mean, I don't think 5% is out of the question. And now the way that we start to think about this is it goes back to the yield curve. And the big debate is, does the Fed cut 0 times, 1 time, or 2 times? But nobody's talking about hikes. And that's really the good news. So if we think that the slope between the 2-year note and the 10-year Treasury, if we think about that spread, if that spread is going to be somewhere more normalized, let's say 50 basis points or 75 basis points, then if the Fed funds rate stops at, say, 4.25%, if you have a normal sloped yield curve, you could have a 10-year note that's around 4.75 to 5%. I don't think that's bad news. If it's because the economy is growing and we're getting decent, and we have relatively low inflation, so you're getting higher productive growth, then a steep yield curve, those bond yields are perfectly acceptable and manageable by the equity markets.
Jim, just hold on to that thought. I just wanted to jump in with a breaking news headline that we've been waiting for. A lot of people anticipating this, getting some confirmation the Israel Security Cabinet has approved the Gaza ceasefire deal. Just some confirmation there that the Israel Security Cabinet has approved the Gaza ceasefire deal. We'll bring you some more updates a little bit later in the programme. Jim, I want to return to the bond market with you once again. Jim, you were talking about the slope of the yield curve, and I'm with you, and I just want to build on it. And for people who might have missed it, the 2 years basically anchored around where the Fed funds is at the moment. So if you're anticipating no real action from the Fed through the next 12 months, 24 months, that makes sense. And then if you just to add another 40, 50 basis points through the curve, just some normal steepness, you can make the argument for where we are absent fiscal concerns. And Jim, that's what I wanted to come to you on. Is there any evidence whatsoever that at the longer end of the curve, we've started to price in some kind of fiscal premium with the incoming administration?
Yeah, we are. We are pricing that in, and this is what people refer to as term premia. The government, the incoming Trump administration, I should say, is likely to run some positive fiscal expansionary policies, meaning that they're going to likely deregulate and they're looking to cut taxes. Both of those things I will call fiscal policy and in thinking about it as expansionary. However, what they're also trying to do is reduce the deficit. Can you do all three of those things? That's the key question. Now, Trump has put in place the DOGE, right, the Department of Government Expenses and Expenditures, and he is looking to reduce some of those government expenses. What we have to remember is that inflation is driven by government outlays. The government outlays in 2024 was over 10%. That is a significant amount of number. It's a big contributor to inflation and inflation risk. If that starts to come down, as Trump is promising that it should, and if it does, then you should have a lower inflation impulse. So you can run expansionary fiscal policy and not have to pay the price of higher inflation. Now, that's the trifecta, effectively. Now, we need to see if that's going to work. But essentially, if the market starts to price this in, and this is an out of consensus view, if the market prices it in, that's really positive for equities, and it could actually be positive for credit spreads and bonds too.
And Jim, that makes a whole lot of sense, but how we're likely to get policy from Trump, given the first time around, given the hints that we've gotten going into his inauguration, isn't even. It's an unpredictable one with often varying parties jockeying to have the influence of Donald Trump. Does that not in itself argue that you're not going to see that plateau in yields that equities need, that there's going to be more volatility, which might in turn hurt risk assets?
Yeah, that's exactly right. I'm glad you brought that point up, because effectively what that generates is a higher risk premium or term premium. So the market's saying, look, I hear what you're saying and I hear what you're trying to do. However, we're a little bit skeptical, and that's building in some of that inflation impulse. And that's one of the reasons why the yield curve is likely to continue to steepen this year until we see this really manifest and come through. So it's not really a done deal at the moment. Look, tariffs is the other thing that's being discussed as well. Is that inflationary, or are tariffs a tax, a one-off price increase? Does it create substitution effects, and does it actually bring down inflation? Depends. It depends on how it's enforced and how it's enacted and how targeted it is. So really the critical element here is to see what Trump actually does in his first, several days, but certainly the first 100 days. And this is what the market is wrestling with right now. And it's built in a little bit more term premium, steepness of the curve, and that's pushed back end yields higher.
What does that mean for cross-asset allocation, Jim? Can you build a portfolio where bonds can have negative correlations to equities that can act as a hedge this year?
So, this is a point that's near and dear to me. Right now, bond returns are very high. They're at all-time highs, highly correlated relative to equities. I go back 110 years on this data. So it is going to be really difficult to build in a portfolio that's very, very well diversified, meaning that if I own bonds, it's a good hedge to equities. If you're passive, it won't be. But if you actively manage your fixed income, if you actively manage your equities, if you're very selective about the investments, about the assets, if you think about the broader parts of the markets like mid caps, where there could be more earnings potential growth and things like that, if you build that into your portfolio, then yes, you can have a diversified portfolio. But if you just go passive bonds, passive equities, they're going to be highly correlated, and you're not going to get the diversification benefits. Bonds will not be as good of a hedge. So you need to be very active and very selective in terms of what you're building in. And if you do, it's a great opportunity.
Jim, just before you go, just on our radar, we wanted your thoughts on Europe. Things are starting to happen. Early days, I know, but some outperformance in European equities. We saw that in Paris, France yesterday off the back of the luxury players. Seen it continue throughout the week. Euro Stoxx 50's had a nice 4-day run. Too early to say whether we're sort of breaking the trend, breaking expectations that we came into 2025 with.
Yeah, don't look now, but Europe's outperforming the U.S., and I think it's very important to highlight that. Why is that the case? In my view, why that's the case, this is part of our cyclical view. Cyclical's doing better in 2025. Effectively, PMIs, manufacturing sectors, have been in a recession essentially for the past 3 years. Europe is very highly levered to their equity market is highly levered to a cyclical recovery in manufacturing, because that generates a lot of their GDP. And I think the European markets are picking that up, especially European financials. We still like that segment of the market right now, but we may expand more into the industrial and manufacturing base. But this is still a very, very good opportunity to diversify your portfolio. Think global. It's not just about the U.S.
Jim, appreciate your time. Jim Caron there of Morgan Stanley. Finishing up on Europe. We saw a record high on a FTSE. Danny, you pointed this out earlier. We've seen that repeatedly, actually, over the last year on the DAX. The DAX had a great 2024, despite people being very downbeat on Europe. It's January 17th. I want to be very careful, the kind of questions I ask, but could this be the surprise of 2025?
I mean, so many people got down on Europe and said U.S. exceptionalism, it's the only thing you could buy. I think the one note of caution is when you look at the things that are performing, DAX and FTSE 100, it's very, very global businesses, and it's businesses that are very exposed to the U.S. This is where the tariff threat comes back into play. That Monday will also matter for these markets that have just started to hit all-time highs, too.
Stocks up nicely over in Europe, up nicely here stateside, too, just not as much. We're up by 0.5% on the S&P 500. Moments ago, some breaking news out of Israel. So let's head over to Tel Aviv and catch up with Bloomberg's Ollie Crook. Ollie, what have you got?
Yeah, so Jonathan, we just got the approval from the Security Cabinet that they will move forward with this ceasefire agreement. This is where the debate had been sort of stuck here in Israel for the last sort of 4 or 5 hours, being debated at the highest level of the government. This now will move on to the next phase of this, which is the full cabinet approval. So we got this statement from the Prime Minister's office that's saying that after examining all political, security, and humanitarian aspects, and with the understanding that the proposed deal supports the achievement of the war's goals, they've approved it. Now, that is a very important line there, Jonathan, because there has been a lot of debate within this government, particularly from the right wing, who did not want to enter into a ceasefire agreement, saying that basically this will only allow Hamas to regroup and that they wanted to pursue this war and basically wipe out Hamas entirely. This leaves the door open very clearly, and this is something that has been won by the sort of far right, in order to continue to sort of re-prosecute this war after the 6-week period. So this is going to be the sort of intense debate within Israeli politics right now. But under the pressure that we've had just on the streets here, there have been protests basically against the government here, basically saying that you need to bring these hostages back. Under that pressure, this has been approved by the Security Cabinet. Now it goes to Cabinet, and we can expect this to be put into force, the ceasefire, for 6 weeks on Sunday.
Oliver, also under the pressure of Donald Trump and Steve Witkoff, that is what really brought Netanyahu to the table. According to third-party officials in the region I've spoken to, it was Witkoff that really did a lot of this heavy lifting. When it comes to the hostages, now that we've had this approval from Israeli Security Cabinet, when will the first hostage be released, and what is that process going to look like?
Yeah, so I can give you a little bit of the mechanics of what that's going to look like. What we understand so far is that this is going to be done in several phases. So the first phase will be 3 female hostages will be released on Sunday. In exchange for that, there will be Palestinian prisoners that will be released by the Israelis. And basically, over the sort of ensuing 3 or 4 days, every three or four days, you'll have 3 or 4 hostages released. And then you'll have the same thing on the other side from the sort of Palestinian prisoners. We understand that there are going to be sort of 33 in this first phase of this agreement. We also understand that that will mean hundreds, if not more than 1,000 Palestinian prisoners to be released. What this will also guarantee is obviously ceasing of the fighting within Gaza, but also a beginning of a withdrawal of Israeli troops, not from the Gaza Strip, but from the populated area, so they can go occupy the sort of eastern corridor of Gaza. And of course, the other critical point here is that this will allow a lot more aid to finally flow back into Gaza after, 45,000 people have been killed and all of the infrastructure and all the supplies really decimated over these last year and 3 months.
Ollie, appreciate the update. Thank you, sir. Bloomberg's Ollie Crook in Tel Aviv, Israel. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief. Happening just moments ago, Israel's Security Cabinet approving the Gaza ceasefire deal. The deal expected to start on Sunday. It includes Hamas releasing 33 hostages, Israel withdrawing troops from populated areas, and freeing around 1,000 Palestinian prisoners. Elsewhere, former central banker Mark Carney announcing a bid to replace Justin Trudeau as head of Canada's Liberal Party. Carney said he's focusing on politics and has resigned all of his corporate roles, including as chair of Bloomberg Inc. And I can tell you just seconds ago, Anne-Marie Chrystia Freeland, the former finance minister of Trudeau, saying she's running to be the Liberal leader.
Not surprised. It was about a month ago that she decided to resign, and that is when Trudeau faced his biggest test, and he was really forced to step aside because of that scathing letter she wrote, Jonathan.
20 points behind the Conservatives in the polls. They've got a very steep hill to climb. And just finally, Los Angeles Dodgers superstar Shohei Ohtani is donating $500,000 to those forced to flee the wildfires. The Dodgers and other allied sports teams are selling LA Strong shirts, with all proceeds benefiting the LA Fire Department Foundation and Red Cross. That is your Bloomberg Brief. Up next, the Morning Calls Plus, Jason Bazinet of Citi ahead of Netflix earnings. That'll be next. You're watching Bloomberg Surveillance. The opening bell 1 hour and 13 minutes away. Equity futures on the S&P 500 positive. Once again, a lift by 0.6%. Let's get you some morning calls. First up, Evercore ISI adding Apple to its tactical outperform list, citing continued growth in emerging markets and strength in wearables. That stock is up by 0.9%. As Manus pointed out earlier, though, some real weakness so far year to date on Apple. Your second call from TD Cowen upgrading Salesforce to buy, saying its recent pullback has created a compelling entry point. That stock is up by 0.25%. And finally, Bank of America downgrading Southwest to underperform, citing execution risk in its product offerings. Let's turn to streaming. Investors bracing for Netflix earnings out on Tuesday. The majority of Wall Street is bullish on the streaming giant. But Jason Bazinet of Citi is neutral on the stock, writing, "We expected to report net additions ahead of sell-side estimates. We like Netflix's strategy and execution, but we don't see material upside at prevailing levels." Jason joins us now for more. Jason, welcome to the show, sir. Good to hear from you as always.
Thank you.
What's ultimately behind that call? You're not impressed by the content slate? What is it?
No, I'm impressed by the content slate. I just think the valuation reflects a tremendous amount of good news. I mean, going into this quarter, people expect great net adds. They're excited about the content slate. Netflix continues to be the undisputed winner in streaming. And all of that is reflected in the stock. I mean, it's trading at 28 times 2026 earnings. That's a pretty full multiple, especially because top line growth, we think, will begin to decelerate as we move into 25, 26, and 27.
Jason, there's also been a lot of excitement around Netflix on live sports streaming. They spent an immense amount of money over Christmas getting the NFL rights, having Beyonce perform at a halftime, to a lot of accolade. But at what point did the expenses start to pay off? How do you justify the spend that they're having? Not to mention it might get more expensive as the Amazons of the world also look at what they're doing and already have to some degree want to get involved.
Yeah, I think there's a little bit of a misunderstanding among generalists about sports. The reason I say that is Netflix will clearly move into sports. It will be very expensive. What people tend to understand is that the sports rights costs essentially is sort of matched by essentially the advertising revenue that you get. So once Netflix stands up a full-throated ad streaming service, the only way you can make this work is if you end up getting more subs. And in the US, of course, Netflix is already quite penetrated. So I'm not as excited. I think going into sports is a smart strategy for Netflix. I'm less convinced that it's actually needle moving in terms of helping the firm grow earnings.
When it comes to getting more subscribers, and especially on that ad bracket, Jason, it was last year that a lot of executives, there's some FT reporting about this, that Netflix was that Amazon was starting to price itself more cheaply than Netflix for people coming in and buying ads. What does that market look like right now? Is there a race to the bottom, and at least at this beginning stage, trying to get advertisers onto the platform?
I would not characterize it as a race to the bottom. I think what ended up happening is because Amazon essentially forced all of the Prime customers onto the ad tier unless you opted out, it ended up causing a supply-demand imbalance for sort of digital advertising. I fully expect that we will reach equilibrium and that pricing for ads will continue to march up. But I don't think this is a race to the bottom. And that's good for Netflix.
What about price hikes when it comes to wanting to engage in whether it's any other streaming service, but also Netflix? Can they have the ability right now in 2025 to raise prices?
Well, it's very interesting. Remember, the company has already guided to 2025 revenues. And they've said that the way to get there is relatively balanced between subscriber growth and pricing. What the buy side has been waiting for is for Netflix to announce a U.S. price hike. Many expected it in the third quarter, many expected in the fourth quarter. And there are elevated expectations that if they don't announce it, at least on this earnings call, that shortly after earnings, they announce a U.S. price hike. And Netflix's view is that they take those price hikes when they can earn it. There's been modest improvement in the level of engagement on Netflix. And so I fully expect that they will take a price hike. If they don't, if something goes wrong, then I don't think it's going to be possible for Netflix to hit the 2025 revenue guidance that they've articulated.
I love how you broke this down in your research. U.S. consumers pay 0.006 per minute for Netflix, very similar to what they pay for television. But why do you think they're waiting so long, if they have the customer base and they're doing well, to hike prices?
Well, it's interesting. When you ask Netflix this question, they say that they don't look at the price of linear TV as a competitor. Having said that, when you go back over time, U.S. consumers are paying exactly the same for Netflix per minute as they are for linear TV. Netflix, of course, is much cheaper than linear TV, but it's about the same price. And I think it's sort of a guardrail, maybe is the way to think about it, that Netflix can't get price too expensive and get that price per minute too high. And so part of their push to move into sports, part of the excitement they have around the content slate is to get that engagement up to earn the right to take pricing up. But the dollar per minute may stay relatively flat.
Jason, I am just hearing a lot of skepticism from you. I know you're not outright bearish on the stock, but as we started this out, you're not sure they can reach the level that is currently priced in. Could you be surprised? Do you think that there is any potential here, or is it just like skepticism all the way across the board?
No, there's not skepticism. My only point is a price hike is embedded in the expectations. And so if they deliver that, I don't think it's a beat. I don't think it causes outsized performance in the equity. They need to announce a U.S. price hike to sort of hit their guidance for the year. It's not bearishness. It's just recognizing a lot of good news is priced into the stock. They have to deliver 13 million net adds. The company sort of said we're going to do better than last quarter, which was 5 million. That's heightened expectations. They have to deliver a U.S. price hike to hit the guidance. That's heightened expectations. The multiple, I think, is relatively full. So I'm just trying to find opportunities where we can make our clients, huge amounts of upside. And I just don't see it in Netflix. I love the company. I love the strategy. I'm just not sure it's a stock that's going to outperform.
Jason, just quickly before you go, can we talk about content? Very briefly, Landman, Paramount, absolutely love it. I'm just wondering how much more of this we're going to see, sort of pro-rural America, pro-conservative content like Landman.
Yeah, I think you're probably going to see more of that. I mean, we have seen sort of, the middle of America sort of underserved from a content perspective for a number of years. And so there is white space out there for Hollywood to capture. And I think the response function, as these shows get a good viewership, will I think sort of cause Hollywood to readjust and serve middle America and red state content, for lack of a better word.
It's happening. Jason, appreciate it. Thank you, sir. Jason Bazinet there of Citi on the latest with Netflix. You watched any of this?
I haven't, but the lineup, the cast is incredible. Amazing. Yeah, Demi Moore, John Hamm, Billy Bob Thornton. I will watch it because you've been going on and on about it.
Been sending you clips.
Yeah, I know.
Why didn't we learn this lesson from Fargo? I mean, take any Midwest show, so good.
It works.
It really works. It's great.
Coming up next on the program, Steve Ricchiuto of Mizuho and Phil Camporeale of JPMorgan from New York City. This is Bloomberg. $60 minutes away from the opening bar with equity futures at session highs. A nice bounce in the last 10 minutes or so. We're higher by 0.6%. With 60 minutes until that cash open, let's get you some movers. It's Manus Cranny. Hey, Manus.
Jonathan, good morning. And it is the chips where we're seeing a little bit of a frisky move. Bottom of your screen, you're going to see Intel up 6%. You can take your punt on why it is. But Barclays have a big note out, which permeates across all of the chip sector, but digs into Broadcom. What they say there is they're raising the price target to $260 from here. They're staying overweight. They stay overweight semiconductors generally. They like the CapEx story. And of course, you're going to see this market bifurcate into the have and the have-nots in the AI world, where they struggle. And that's why I'm struggling to understand the move in Intel. They're going to struggle to get more positive on cyclical semis, analog, PC, and handset. Yet Intel is flying by nearly 5%. Let's see what the story unfolds there. Apple. I brought this to you earlier, down 4% yesterday, regaining a little bit of footing this morning. This stock is down nearly 9% in the month of January. They had a pretty awful iPhone sales in the fourth quarter, as you know that. But Evercore say it's a tactical outperform. The strength in services and wearables is going to be the key. Yeah, the big wild card is China, but for them, iPhone 17 and the SE Plus is another one that is perhaps better than feared. Rounded off with a little bit of crypto, we know that there's potentially an executive order coming down the pike on a national Bitcoin stockpile. That's a sort of a given in this, but bear in mind Coinbase, post-election frenzy but the stock closed down 27% into the close of the year. We clawed back 50% of that. And Oppenheimer come out and they say this is a buying opportunity. This is where you've seen perhaps the worst of it past, and it's trading at a bargain. A bargain. I love a bargain. Bargain discount relative to Robinhood. Everything's a bargain until it's a bit more painful in the pocket.
Manus Cranny, thank you, sir. Appreciate it. 60 minutes out from the cash open. Let's turn back to the Federal Reserve. Cleveland President Beth Hammack telling the Wall Street Journal, quote, "We still have an inflation problem and need to continue to finish the job." This is Governor Chris Waller says cuts could come in the first half of the year if inflation data stays favourable. But Steve Ricchiuto of Mizuho expects the Fed to stay on hold through 2025. And Steve joins us now for more. Steve, good morning.
We started on the same day.
Good to see you. What explains the difference right now for you between the likes of Hammack and Waller?
Yeah, there is a real disconnect between the belief as to whether or not global disinflationary pressures will dominate over domestic cyclical inflation pressures. And that's the debate. That's why there's the confusion even amongst the members of the FOMC, because it is a really important question as to whether or not that global deflation, especially with a stronger currency, will overwhelm the inflationary implications of a very tight labor market and an economy running above trend for 5 years, which is the longest period in the post-war that we've ever seen the economy run above trend, and yet we've got this Federal Reserve that thinks it needs to cut interest rates.
Danny brought this up. I do want your opinion on this. Is Governor Waller auditioning to become the next Fed chair?
I quite possibly, but I don't think the audition for Donald Trump is, oh, we've got to worry about inflation or we've got to tighten interest rates. I do think the concept that cutting interest rates automatically leads to lower long-term interest rates is a mistake. We've seen that now for 100 basis points. And yet I don't think that's fully accepted by this incoming administration yet.
Given that they've cut, yields have gone higher, what is the risk that this is a Federal Reserve that has allowed the bond market to get away from them and allowed the bond market to get away from them at a time where you have the administration that does seem more acutely aware of that and of the pressures and maybe their ability to turn around and pressure the Fed themselves?
Well, I mean, if this Fed were to take the directive saying, I really want you to target 2% inflation, then I think you would have a strong argument that yields should move lower over time. The problem is this Federal Reserve feels 2% was too restrictive. They're probably more comfortable with it being at 3. That's fine. If you're going to say it's at 3 and you're going to defend it at 3, that's fine. But the bond market needs to reflect what that means. The bond market today doesn't. And the reason why it doesn't is most of the people in the business only remember the new normal period, which I said before on the show. That was the biggest mistake Bill Groth ever made. That was not a normal. That was an anomaly. And trying to think we can go back to an economy running at above trend economic growth with 3% unemployment and 2% inflation is just not valid.
So one of the arguments that I have heard to say, okay, this is disinflation happening, it's just happening more slowly, that the consistent piece of data that we continue to get are things like the quits rates, that workers are not leaving their jobs, and those who do leave, it's harder to find a new job. And therefore, you do see this just ever so slightly slow grind lower in wage growth, and that means soft landing is on track, opens the door to cuts. What do you say to that argument?
Well, again, that was a 2024 situation. And it was a 2024 situation because the perception was we were going to get a big tax increase in 2025. So, therefore, companies were sitting there saying, I've been underperforming on earnings. Remember, 2023 earnings were up less than 5%. I have to start control costs. How do I control costs? I slow down the pace of employment. I now got up to 10%, eventually 10% earnings growth. And now I no longer have the prospect of tax increases. Do I now go back to the situation of growing my business because I'm pretty comfortable now that I could get 10 to 15% earnings because we're probably going to have a 6% nominal GDP? And does that then change the dynamics where we're sitting here 3 months from now saying, gee, the quit rate is going up. People are getting jobs pretty quickly. What's going on? And the answer is that's what's going to happen. You've unleashed animal spirits. Even before they've actually executed anything whatsoever, you have a change in mindset. Look at what's happened in terms of M&A activity. The announced deals have picked up significantly. Why? Because we know there's a more friendly administration coming down the pipeline, so people are starting to move things. And even though we say M&A destroys jobs, it may take out some jobs initially, but it tends to create jobs over the longer term.
Okay, so let's talk about some of those policies that we're actually going to see begin to be implemented potentially as soon as Monday. You mentioned deregulation and M&A, very excited, light regulatory touch, fine. What does potentially the immigration policy mean for the labor market at the same time that we might have a tariff policy that, whether it's inflationary long term or one hit, it could be inflationary?
Let me step back. I'm not so sure it's going to be inflationary at all. Again, this is where I disagree.
Even the
with
washing
a lot of
machines
people.
from last time around?
I think what winds up happening is with the dollar getting stronger and with global excess supply, look around the world. The world's a mess. Okay, and we've produced more global excess supply after COVID than we had before it. So I honestly think margins take a hit for suppliers into this country, and I think the currency offsets a good portion of that. Getting back to the immigration concept, I don't think there's any realistic argument to suggest that people want to go out and deport even illegals that are adding productively to the economy. I think there may be a decision to deport people who are coming into the system because they've been arrested and maybe then getting deported, as opposed to going out and trying to get a vacuum cleaner and sucking all these people up.
Speaking of tariffs, we do have Chinese news organizations reporting right now that Trump and Xi are holding a phone call. So it looks like he's getting ahead of potentially what this tit for tat might be. When you look at the tariff policy, do you think that's where it's going to be headed? Less so in Europe, maybe Canada, Mexico, mostly focused on Beijing?
Oh, clearly, he started that particular piece of the equation, and that particular piece of the equation has become consensus conversation. And I think he's going to continue to push on that because it is a big national security-related issue. Again, a lot of what's done in here, I think, is positioning. And I think we have to then go back and wait to see what actually gets accomplished. I don't know where they're going to go with this. I don't think a lot of people do. And I am disappointed by the bond market's desire to believe that the incoming Treasury Secretary somehow or another makes every bad possible thing go away, because that's not the position of a U.S. Treasury Secretary. And I'm not so sure just because you've been successful in business, you're going to be a great Treasury Secretary. We've seen several successful business people be horrible Treasury Secretaries. It's a very difficult job. And a lot of what you're doing is coordinating efforts with people on the Hill to get things done for your president. And just because you're really successful at your job doesn't mean you're good at doing that. There are certain people like a Steve Mnuchin who had the skill set to do it. There are other people we can mention in history, but most people, viewers, wouldn't remember who they were. But the reality of the situation is making the assumptions we're making is the mistake. Perceptions are not reality. And this is the point I was getting at with regard to the 10-year note. People are saying 4.80 is a great level to buy because how long has it been since we've been there? 5% is a fantastic level to buy because we haven't, we touched it once in 2023, and then you're going to go back to 2007. I wasn't even in the business in 2007. Well, I was in the business in 79. And I can tell you, that's a fair level of rates. It's actually a very accommodative level of rates. And people are worried about the mortgage environment in this country. The mortgage environment is not the reason why we aren't getting housing in this country. The problem with really housing is that we don't want to build homes because it's very expensive to do it. We've taken out the speculative aspect of that market through things like Dodd-Frank. But in addition to that, the price of the homes are high. And we have to remember, we do have an aging population, so how much more of this do we need? So housing really doesn't add that much to the economy.
Well, Steve, you also know that the effective mortgage rate in the United States of America is around 4% at the moment. It's nowhere near what the market rate is, and a lot of people are locked in. So we have a supply issue, but for different reasons.
Well, again, why would you leave unless you have to go do it, unless you really need to expand
Do you
your
not
product?
think then reducing interest rates would unlock some of that supply?
No, I don't.
People would feel more mobile
so.
again.
No, I don't think so.
Why not?
Because I think a lot of people that are in the position where they've locked in, given how low their rates are effectively, some of them that we know in particular, personally, anecdotal information, is they've opted to rent their home.
I'm trying to get Lisa to sell her home.
Yeah, exactly. I knew you were going to say that.
Good luck with that.
That's what I'm trying to do.
She's at
trying
what?
to do an exchange.
3%?
I think she's at 3%. It was a great trade.
Yeah.
You won't be the first person to complain about the bond market. You won't be the last. All right, Steve? It's good to see you. Steve Ricchiuto there of Mizuho. Just want to get you up to speed on that headline that crossed the Bloomberg just moments ago. A report that President Xi and incoming President Donald Trump have held a phone call. No clarity or details on what they actually discussed, which is the important part going into next week.
Hopefully we get a readout. Even though he's not the president yet, he will be the president on Monday. So hopefully we get a readout on what him and Xi Jinping discussed. Because obviously we're seeing a lot of different policies regarding China be discussed? Scott Bessent was very bearish on China yesterday in his hearing. Talked about the fact that they think they're in a recession, they think they're in a depression. Talked about the national security concerns when it comes to China and the fact that maybe they will be using tariffs, either blanket or negotiating chip when it comes to Beijing. At the same time, Donald Trump invited Xi Jinping to come to his inauguration. Maybe this phone call was just an RSVP. I'm so sorry I cannot attend, but I'm going to send my vice president instead.
I think it's just a good moment also to take a step back and think about how different it is than 4 years ago. Hours after Biden's inauguration, China had issued sanctions on 28 Trump officials. Then months afterwards, we had finally talks between the two sides that completely fell apart in Alaska. This is a very different starting point, and at least positively for the market, despite some of the hawkish people in Trump's cabinet, talks are happening and people are attending the inauguration.
He understands how to be president. He understands where the levers of government are. It's going to be a different one, a very different one, which is why so many people think they're going to move so much more quickly this time around.
Because he understands where to push, where to pull, and also based off conversations I've had with people in the Trump administration, one thing that they want to do that's very different, geopolitically speaking writ large, not just when it comes to China, they understand the power America has with its military might and its capital markets, and they're willing to brandish it around the world the same way they don't think the Biden administration was.
Equity futures right now positive by 0.7%. Session highs going into the opening bell, about 45 minutes away. We've got equities up and we've got bond yields down. Bond yields down in America by, let's call it 4 basis points now. So this rally's picking up. We're down 4 on a 10-year. We're down 5 on 30s. Phil Camporeale of JPMorgan Asset Management keeping a close eye on Fed policy, writing, we believe the Fed will be on the sidelines for the first half of the year. Less easing from the Fed is much different than tightening, particularly if the easing is not needed by the economy or the stock market. Furthermore, this economy is not interest rate sensitive. Phil joins us now for more. Phil, good morning.
Good morning.
Tons to unpack there. Last time we caught up, you talked about a soft landing, gradual rate cuts and a broadening out of equity returns. Does this setup challenge that?
Yeah, so we have new information, John. I think, but what's not new is that the 10-year Treasury rate continues to push around the equity market. I mean, the 10-year Treasury rate's boss at this point. You saw that last week with the payroll report. Yields spiked, and the equity market had its worst day since the Fed's hawkish cut in December. And then Wednesday, Danny, you said it, we got like this little bit better than expected inflation. And we had the best day since the day after the election. Are you kidding? Right? So we're still very interest rate sensitive when it comes to the equity market. But the true north here, John, and we've kind of come full circle, is inflation. I mean, last year we came in and we probably sat at this table 12 months ago and said, is inflation going to cooperate enough for the Federal Reserve to cut policy? We went to the summer and now it's time for policy to adjust. Fed cut rates by 100 basis points last year. And now we come into this year. Is inflation going to cooperate enough for the Fed to cut policy? But John, our true north still is this very low probability of recession that we have over the next 12 months, which is akin to the story around the soft landing, the broadening out rally. And I just can't say enough good things about the U.S. consumer. I can't. I don't even know where to start. Whether it's all-time high in household net worth, 20 straight months of positive real wages, 20 straight months, and then the coup de grace you mentioned in the last session. People's first-time homes just became their forever homes because of their forever mortgage rate.
They are locked in.
And they're locked in. And I think that is the biggest reason why we didn't go into recession in years like 2022 and 23. And that's a very slow-moving signal, John.
Well, Phil, lucky for you, basically everyone who thought there was going to be a recession last year just got slapped in the face and has completely removed all of those calls. But does that mean every time you see a sell-off that's prompted by something like yields, you just want to buy that dip? Because as you say, it's about consumers still spending. It's about a strong economy that has been able to withstand high yields.
So, Danny, good question. And people have come on the show talked about, but why are yields moving higher? I think last week with that payroll report, there's no such thing as kind of good news is bad news when it comes to the labor market. If you're producing jobs, that's a really good sign. Yields went up, and I think that was a reason, why the equity market was supported this week. But if they're going up because this kind of unhinged acceleration, whether it be shelter, whether it be insurance, or any service sector, lodging away from home, if that stuff, food away from home, if that stuff is going up, Danny, that's a warning signal for us. That's probably the biggest risk that we have. It's this cost-benefit analysis that policymakers need to do here. Does the benefit of lower rates outweigh the cost of potentially accelerating inflation? And that would be a pause or a warning signal for us. We don't see it. And, nominal growth is made up of two things. It's made up of real GDP growth and inflation. If the inflation part is going up and real growth is coming down, that's bad nominal growth. But right now we believe about a 2.5% real GDP, 2.5-ish% inflation, 5% nominal growth. If you Google nominal growth and S&P 500 earnings, you're going to get a really nice picture. And that's what we're counting on.
Recent Michigan survey, though, was talking about consumers, their expectations are going to be much higher for inflation. Are you concerned about a self-fulfilling prophecy?
Yeah, like I mentioned, the inflation story is not over. We're declaring victory.
You say consumers are doing well. So at what point do you think they really start to push back?
Yeah, I think that goes back to the wage story, Anne-Marie. So if you have, wages right now, average earnings 3.9%, that's right on top of the 50-year average. Back in 2022, when the Fed was raising rates, it was up at around 7%. So I think the consumer, if we go to a labor market that unemployment rate going below 4%, average hourly earnings picking up, that would be a warning signal. And, inflation is okay. Again, if you get the real GDP growth on the other side, it would be the stagflationary part that we would worry about, and we're not seeing that right now.
Headline crossing a terminal moments ago. I'm sure you heard us talking about it, that she and Trump had held a phone call, according to reports. Yeah. What are you expecting on trade in the next few weeks? What's the base case for you and the team?
Yeah, good question. And there's two parts of this, John. The first part, and we've talked a lot about it, the deregulation side. That's the positive. The wild card is going to be the headlines around tariffs. Annualized performance of the S&P 500 in Trump 1.0 was 16% annualized, with all of the noise and headlines.
Stock did well.
Around tariffs.
Economy did well.
Around
Biden
tariffs.
kept the tariffs.
Yeah.
Stocks kept going up. Does it make a difference this time around?
We don't think it does. We wouldn't be overweight 9% in stocks if we, in a 60-40 portfolio, if we believe that the tariff issue was going to hurt kind of growth and earnings and things like that. I think that the bigger positive is the pro-business environment from President Trump.
What is it about this? And I'm intrigued. I'd love your opinion on this. So I get it. They're pro-growth.
Yeah.
But for me, it might be like a football game.
Yeah.
With and without cheerleaders.
Soccer or American football?
We can go with your version because we don't have cheerleaders in soccer. The game's the same. 3% GDP under Biden. They might not have been pro-growth. They didn't talk well about business, and they were very much against M&A. Yeah. How different is it going to be?
Yeah.
The actual economy, not the cheerleading, the actual economy.
The actual GDP number is not going to be very different, okay? But if you look at the small business survey in the last 2 months, John, we saw the biggest 2-month jump in the 39-year history of that survey across the board. And when we talk about deregulation, it's not just that you're going to get less kind of cost of rules that were under Trump 1.0. Do you realize the Biden administration in the 4 years had four times the cost of regulation than President Obama, not President Trump? So this is something that we think is going to, and we're seeing it in the surveys, something that we think is going to be really positive, adding to that kind of broadening out rally. Mid-cap, we don't have as much mid-cap as we did in December when I was here last time because, again, the new information on inflation risk. But we still do like a combination of large cap and mid-cap in the portfolio. And in fixed income, this is the highest starting yield on the 10-year note since 2007. Okay, coming into a year. Again, we got to 5% before, but starting the year. So we need a backup of about 75 basis points to break even with kind of the coupon.
Yeah.
We don't love core bonds here. We like high yield a lot more. That's adding durability to the portfolio. But as an asset allocator, we do have to think about kind of the cost benefit with core bonds here.
Phil, it's good to see you. As always, buddy. Great to catch up. Phil Camporeale there of JPMorgan. Equity futures up here by 0.7%. Let's give an update on stories elsewhere this morning. Here is your Bloomberg brief. Bloomberg reporting that President-elect Donald Trump is planning an executive order to make crypto a national priority. The team also reportedly considering the creation of a national Bitcoin stockpile. We'll see. Elsewhere, the US government targeting Novo Nordisk blockbuster weight loss drugs Ozempic and Wegovy. The drugs will be subject to price negotiations in an effort to reduce Medicare costs. The legislation hopes to save the government more than $200 billion over a decade. And finally, SpaceX Starship rocket exploding just minutes into its 7th test flight. The rocket losing its top section, but its lower portion was brought back down to Earth successfully. SpaceX CEO Elon Musk pointing to a possible leak and saying next month's launch is still on track. That right there is your Bloomberg Brief. Up next, we'll set you up for the week ahead with one thing in mind. Day 1 of Trump, version 2. Equities up here on the S&P 500 going into the opening bell. We're positive by 0.6%. Next week, shaping up as follows. On Monday, Trump's inauguration and the World Economic Forum beginning on Tuesday. Earnings from Netflix and United Airlines on Thursday. Another round of jobless claims. And on Friday, a BOJ rate decision plus some data in America, including US PMIs and UMich sentiment. As we count down to Inauguration Day, let's catch up with Bloomberg's Tyler Kendall for the latest in Washington, D.C. Tyler Kendall, a call between President-elect Donald Trump and Xi Jinping. What's the news?
Yeah, good morning, John. Well, news of this call coming, of course, as China's Foreign Ministry of Affairs confirmed yesterday that they will be sending the country's vice president to Trump's inauguration. Also coming as we get more news about who else will be there. We know Bloomberg News is reporting that a whole host of CEOs, including Elon Musk, Mark Zuckerberg, Tim Cook, and also Jeff Bezos will be there. And then new reporting that TikTok CEO Shou Chew could also be in attendance. Of course, as you've been covering on the program all morning, Inauguration Day coming just one day after that expected ban will go into place on TikTok unless the Supreme Court intervenes or they announce some sort of deal to divest. Now, I had the chance to actually catch up with Democratic Senator Mark Warner on Capitol Hill yesterday. He's the ranking member on Senate Intelligence, and he was the chair when the TikTok ban first passed. And he said that he was confused by this invitation and that he doesn't understand how it squares with the incoming administration's get tough on China rhetoric. Of course, John, President-elect Trump would likely he wouldn't likely not agree with that assessment, considering he says he's trying to broker a deal with all sides to get this negotiation over the finish line.
Tyler, thank you. Looking forward to your coverage into the weekend and on Monday morning. Bloomberg's Tyler Kendall. Tune into special coverage on Monday, 11 a.m. Eastern Time. Helping to lead that coverage, Bloomberg's Anne-Marie. You'll be breaking this one down. We'll be over in Switzerland, breaking down the reaction to everything that happens in Washington next week.
Yeah, so I'll be at the Capitol when President-elect Donald Trump will be sworn in. 45 becomes 47. And then what's going to happen is everyone in Europe at Davos is going to be running around trying to understand what this all means.
It's a Trump takeover, and he's not even there. This is the lineup for next week. Some highlights for you. We'll catch up with JPMorgan's Dan Pinto, NYSE President Lynn Martin, the Bank of America CEO Brian Moynihan, and Morgan Stanley's Ted Pick, and a whole lot more. Looking forward to breaking it all down with you. From New York City, enjoy your weekend. This was Bloomberg Surveillance.